Hello, all. A very good morning. Hope you are all doing good. Guys, can you hear me? Am I audible? Please raise your hands if you can hear me. Okay, I can see people raising hands. So, chalo. I hope you can see the screen. I can see people are still joining in. So, let's start with understanding like why stock market. So, why stocks? There are so many asset classes out there. It can be real estate or gold. You can invest in bonds, cryptocurrency. There are so many other asset classes, right? But why we are investing in stocks? So the objective would be better returns, right? Better returns than FD, better returns than real estate, gold, so on and so forth. And to generate those better returns, what kind of approach you are following or anyone would be following? Returns are always driven by the approach. If your approach is right, then sooner or later you will generate good returns. But what generally people do in the stock market is they invest based on random recommendations. Like, for example, they watch news channels, they get attracted to what the news anchor says, and they go and invest. Or they join some random WhatsApp groups or let's say Telegram channels and all. They watch YouTube videos and they invest. So, do you really think that's the right approach of how to invest? I mean, going about investing your money? So that's not the right approach. That's the reason, I mean, majority of people lose their hard earned money in the stock market. So you need a process or a system. I mean, a time tested process is something that is required to generate better returns in the stock market. You cannot randomly, follow whatever strategy you want and expect returns is not going to work. And in our case, the time tested process that we are following is value investing. So whatever recommendations that I do or generally in my portfolio or whatever I am recommending as well, we are using value investing as a philosophy. And I mean, is it a time tested process? Value investing is actually pioneered by Benjamin Graham somewhere around in 1940 45. So it's almost like how many, like 90 years now, almost 90 years. Many investors made money using this approach. It can be Warren Buffett, Charlie Munger, Seth Klarman, Howard Marks. In India, we have Ramdev Agarwal, Parag Parikh, so on and so forth. So a lot of people, like thousands of people, created huge wealth by using this time-tested process that is value investing. And of course, we are also using it in our approach. So what exactly is value investing? So according to value investing, there are three types of stocks you'll find in the market. One is overvalued stocks, the other is fairly valued stocks, and this is what we are looking for, undervalued stocks. What exactly is the difference? So if someone asks me like what exactly is value investing, my answer would be, buying 100 rupee note at 50 rupees. So value is 100, price is 50. So that is a 50% discount to intrinsic value. So buying stocks at a discount to its intrinsic value is what value investing is all about. So what is overvalued? For example, let's say there is a stock and its value is 100 and it is trading at 150 rupees. That is overvalued. Fairly valued is if the stock is trading around 100 rupees and value is also 100, that is fairly valued. Undervalued is nothing but stock is trading at, let's say, 40, 30 or 50, but its value is 100. So that is a deep discount to its intrinsic value. So that is undervalued stocks. So in our process, what we are expecting is you buy an undervalued stock, identify, buy an undervalued stock, and you either sell it at fairly valued or better you sell it when the stock becomes overvalued. In our case, we buy undervalued stocks and sell when they are overvalued, and we repeat the process. Once we sell the stock, we get cash, and then we try to identify new undervalued stock, we invest there, and we follow the same process. So we repeat the process. So in value investing process, or at least the process that we follow, this is what we look at. So for example, we start with balance sheet, income statement, cash flow statement, profitability, generating ideas. We try to understand the favorability of the industry, moat, management, valuation, when to buy, when to sell, portfolio management, cash management. So everything that you see on the screen is what our process is all about. So this is what we generally do. Now, like I said, we are looking at finding undervalued stocks. So in this, there is something called as valuation. Now, instead of directly focusing on valuation, why we are wasting our time on balance sheet or income statement or cash flow statement? Like, what is the reason for that? The point is very simple. They are all interlinked. Valuation is always the end game. Whenever I'm looking at a stock, of course, I want to value that stock, try to understand the intrinsic value. But before I reach the valuation, I need data. I need the information. So that information is like a raw material. Valuation is the finished product. So input is all this information, that is balance sheet or income statement or cash flow statement. Without that information, we will not get any output, right? So we are doing all this analysis not for the sake of it. There is a purpose for that. The purpose is valuation, and going forward, you'll understand. Once I'll take it, I mean, practically also I'll show you. So once we get into practicals, you will realize like why we are doing all this, because each and every information that we collect is going to help us during the valuation. Got it? So of course, in this presentation, mostly I want to focus on the practicals more than theory. Of course, theory is also covered, but more than theory, I want to focus on the practicals. And remember one thing. So whenever I am trying to analyze a stock or invest in a stock, I focus more on why rather than how. For example, have to analyze a balance sheet, have to analyze income statement, or have to analyze cash flow statement. How is important, but more than how, you should understand the importance of why. When you know why you are analyzing something, you will not do it for the sake of doing it. So why we should analyze the balance sheet? You should know that. Why we need income statement in the process of value investing? You should know that. The moment you realize the importance of why, how, why, when, what, all of those things will fall in place. But if you don't know the purpose, what is the objective, then whatever analysis you do, it won't help you. So eventually, whatever you are doing should help you, in the end. So start with why. And of course, I'm going to start with why. So before we start analyzing stocks and all, I want to show you the actual process. So what today's presentation is slightly different from what we used to do in the past. So how it is different is, so in today's session, what I am going to do is I am going to take you through the step-by-step process. So generally in the past, what I used to do is I would cover the topics, balance sheet, income statement, cash flow statement as topics I would cover. But today what I want to do is, instead of covering topics in detail, I want to focus more on the practicals, and I want to spend more time helping you understand the concept of valuation. I want to spend most of today's session on valuation, because end of the day, that is what our USP is. So trying to identify the value is our USP. So I want to spend more time there. But we are not going to value every stock, right? So there is a 1 second. So initially what I would do is like uh, for generating ideas. So there are around 5,000 stocks in India right now, more than 5,000 stocks. So as an individual, we don't have that much of time. Like if you go and look at like 5,000 stocks, try to understand or analyze 5,000 stocks, it will take a lot of time. So for example, you have 10 lakh rupees today. You want to invest that 10 lakhs. You need 15 stock portfolio. Out of this 5,000 stocks, which 15, I mean, you will analyze, or in which 15 stocks you'll invest. So that's a Herculean task. By the time you go through 5,000 stocks, it will take years. By the time the investment opportunity will be gone. So we need a process, right? We need a process that can help us in narrowing down the investment universe so that we can analyze or we can pick stocks efficiently. So initially what I did was like somewhere around in 2018 or 2019, I don't remember exactly. I did spend almost 1.5 year going through every stock. So, I mean, around 5,000, something like that. So I spiral binded a book and I used moneycontrol.com. So back then I didn't had any Excel sheet or anything like that. So what I used to do is I would manually go through each and every stock. 5,000 stocks I've gone through. It took 1.5 year. And of course, after going through all those stocks, I have shortlisted some stocks. So around 200 or 150, 200 high quality stocks. So, I mean, manually and I mean, I used to analyze, but if at all I like the growth rates or financial health or profitability, I used to pick them and I kept it in my watch list. And after that, what I did an exercise. So out of all the stocks that I have shortlisted, which were in the watch list, what are the common parameters? Because end of the day, these are the things I am going to look for in a stock. So if I can get those parameters right, so eventually I can easily shortlist the stocks. I can discard the bad ones, keep the good ones using those parameters. Eventually, I realized I can use screener.in and I can just input those parameters and I can run the query and screener will provide me the ideas. So this happened eventually. So these are the queries that you can see on the screen. So basically these are the queries I have shortlisted after going through that 1.5 year process, shortlisting stocks, trying to identify the common parameters. So these are those common parameters. Now, for quite some time, I were only using these queries. So you can see here, we'll get back to this again. We'll get back to this, but you can understand there is debt related queries. There are, you can see the growth related queries, profitability related queries. So this is what I would do. Like I would input the parameters and I would run the query. As you can see, 57 stocks showed up. So from 5,000 stocks, I narrowed it down to 57. So like that is more than 99% of investment universe is reduced. Now within the 57 stocks, what I can do is I can dig deeper. I can do in-depth analysis in this 50 stocks and then I can eventually get to those 10 stocks or 15 stocks portfolio. But I would say like after COVID, this is also not working what I would say like efficiently or optimum ideas are not available here as well. There is a reason for that. Before COVID, whatever parameters, I mean, you can see here the parameters are long-term averages. So profit growth 5 years or profit growth 10 years, return on assets or return on capital employed 3 year, 5 year, 10 years. So we are using long-term averages. And COVID, that 2020, 21, those 2 years basically disturbed the long term averages. There are many high quality stocks and they are not even showing up in this list. The reason is because of 2020, 21, because of big negative numbers. There was COVID, there was lockdown, there was slowdown. So because of that, some good companies were also not showing up. So I thought like the narrowing down process is not working at an optimum level. So for the last 2.5 years, what I am doing is instead of using this, I am using a very simple query. Of course, the workload increased a bit, but to generate those best returns, I mean, applying some work is required. So this is what I am using as of now. So whatever the monthly recommendations that I provide, uh, new ideas that I provide is coming from here. So market cap greater than 300 crores. So actually I used to put it at 500 crores, but if I am putting it at, as you know, for the last I mean, at least for 1 year, we didn't had many opportunities because it is bull market and the market is at the peak. So the investment universe is itself shrunk down to like very few companies, and within them there are many bad quality stocks. So what I did, instead of putting 500 crores, I reduced it to 300 crores. But I am not going below 300, because if I go below 300, like most of the companies over there, they don't, I mean, provide the data. Up to date data is not available, and most of the promoters treat these companies as if they are running some private company. So they don't do conference calls, they don't provide investor presentations, even annual reports are also not timely updated, website is also not updated, so it's very difficult to get the data. So I generally, you know, put it at 300. I don't go below 300. And the next is price to earnings ratio less than 20. So only these two parameters I am using as of now. The reason is, like I said, after COVID, with all those parameters, I am not able to find, I mean, some good quality stocks are also not able to get into the list. So I am using this. And as of today, you can see 548. Now, what I do, I'm not going to go through like each and every, I mean, in detail, I'm not going to go through each and every stock. What I am doing is, I am getting ideas here. That is 548. It would take me few hours, maybe 5 6 hours, to go through each and every stock, but I am not going to do the entire analysis. I am going to do, for example, let's say Witron Informatics. So currently trading at 6 PE, every stock will be less than 20 PE. So that is the query we have incorporated. So you can see here all the loss making years. You can see here. Now you know, like, we don't invest in loss making companies. So this is discarded. It would take me 1 second for me to discard this company. So I'm not spending a lot of time. So Witron Info, I just clicked on that. I realized it's a loss-making company. Only in the current year it is making some profits, which I don't know whether it is sustainable or not. So I am not convinced. And first of all, loss-making years is where I have lost this stock. So I'll just discard that. So in this way, there the number might be 548, but again, if you go and check the high quality stocks, you don't find that many high quality stocks. Most of the stocks we would discard in 1 2 seconds. And of course, from here, one of the stocks that we have uh, recommended recently was Mahanagar Gas. So, what I'm going to do in the presentation is, so I'll take Mahanagar Gas and I'll take you through my approach. So, from end to end. So, from the beginning to end, what I'll do with this stock. For example, I'm looking at Mahanagar Gas for the first time. So, I went to screener, market cap more than 300 or P less than 20. So I run the query. I got many companies. Out of those companies, Mahanagar is also one of them. So I did some, you know, some glance of numbers. After looking at the numbers, I realized, okay, sales are growing. Sales growth is good, but margins are little, you know, cyclical. There is some cyclicality in margins, but as of today, the margins are much lower than the long term average. So a good company, profitable company, currently generating lower than long term average margins, can be a mean reversion kind of investing. I mean, there is a possibility for the margins to revert back. So that's why I got interested. And if I check the balance sheet, the debt is also very less. And if I check the cash flows are also very good. So I realized, okay, this company I can take and I can dig deeper. If I am convinced, I'll recommend it. If I'm not convinced, I again discard it. As simple as that. So what I'll do is, first I want to get the information about the stock. I liked in the first 30 seconds or first 1 minute after going through the stock, I liked it. But I'm not yet convinced whether to invest or not, whether to recommend it or not. So that will take the, you know, rest of the process. And there is a step-by-step process of how we go and analyze the stock. So first thing that I do is, as you know, I'll export to Excel. That will do first. So once I export it to Excel, I do the 2-minute test and all. But before I go there, one more thing we can do here is the documents. I need information, right? Now, there are many sources for information. For example, you can get information through newspapers, through magazines. You can watch news channels and you will get information. Or this is Mahanagar Gas. What you can do is you can go to YouTube, let's say, Mahanagar Gas stock analysis. You can search. There will be many creators who would have made videos on Mahanagar Gas. You can go and watch the videos also if you want. So you can source information from various places, and most of these places are free. On the internet, everything is free mostly. But what I would personally suggest is, or what I would personally do is, the most credible and the primary data you will get it from the company itself, not anyone else, not bloggers, not YouTubers, not TV anchors, not in the newspapers or anywhere. Of course, you can go and check. I have no issues with that. But the first thing that you have to do is you have to check what the company has provided. So, for example, every year the company will provide this annual report. So it is basically annual report. As the name suggests, every year you will get this report. Every company should publish an annual report, and this is where you will get a lot of information, the business model. You will find management discussion and analysis, and most importantly, the financial statements like balance sheet, income statement, cash flow statement, all of that you will find here. So this is the most important document. So before investing in a stock, the first thing I do is I check the annual reports. Then there is credit rating report. So again, credit rating report is also very helpful. You will get to understand the business model, the cycle it is in, whether it is a cyclical company or a consistent company, their strength, their weakness. You will get to know many things. And of course, this is conference calls, transcripts. You can directly attend the conference calls, or else you can read their transcripts. So here also you will get to know like what kind of management it is. There will be Q&A session. So there will be questions and the management would answer those questions. There also you will learn many things about the company, the current practices, or whether if there is a margin fall, like why margins fell, what is the reason, and what the management thinks, whether the fall in the margins will sustain for quite some time or the margins can revert back immediately, like what the management thinks. Not everything the management says is right, because anyway no one knows what future holds, but you will get some idea of what's happening in the industry. So these are the primary documents you should go through before going and reading newspapers or magazines or watching videos on YouTube. This is the first thing you should do. So let's start with the annual report. So this is obviously the first thing that I do. I go and check the annual report. Now you can see here this document has got 172 pages. 172 pages is, obviously that's a very big document. So looking at 172 pages itself, feels like, should I go through all the 172 pages? Boring information. You will find all the numbers or all the business related information. So most of this is boring, right? So that's where people don't even check, because one, they don't know how to read it. Two, they don't know why they should read it. Three, they don't know exact process of getting the information. So let's start with why you should read the annual report. You should know that. The moment you understand why you should read it, it becomes easier, because a lot of noise is cleared and you will understand the exact purpose of reading it. I am not reading or going through the annual report just for the sake of it. I have a purpose, and that purpose is I want information. That is the reason I'm going through the document. What information, as an investor, I want to know the information, that is, for example, what business they are in, what products or services they are selling, how they are making money. So basically, how much money they are making. This you will find in the financial statements. What is their debt? How much debt they have? What is the cash? What are their assets? What are their liabilities? Whether they are generating any cash flows or not. What is the profitability of the company? High profitable company or a low profitable company? What is the industry structure? Is it favorable or unfavorable? Do they have any kind of economic moat? what the management is doing. Is it a high quality management, low quality management? And eventually I want to value stock. So all the things I mentioned so far we are doing it for the valuation. So I want information, collect all these informations which can help me in valuation. So there is a clear purpose. The first document that you see here, whenever you see the document, I don't need 172 pages to be honest. Because in the annual report, you will find two kinds of informations. One is non-financial information. The other is financial information. Non-financial is also important. Financial is also important. But broadly, what you will find is there will be PR activities. There will be standard, standard mentions from regulatory. For example, SEBI says that this is a mandatory requirement. So you will find mandatory requirements, and you will find their visions and missions and general, story of the company. So this is what you will generally find. So three things: PR activities you will find, mandatory requirements you will find, cultures, visions and missions also you'll find. What exactly is more important here? PR activities. So once upon a time, so companies would send physical documents. Today we have PDFs. Once upon a time, like physical documents were only available. So during those physical documents, the annual report would contain only 20-30 pages, because printing the physical documents is expensive, right? So if a shareholder wants an annual report, they have to send the physical annual report to the shareholder. It is expensive. So they used to keep it 20-30 pages. But now, since we have got the PDF, and PDF is not expensive, right? 172 pages or 1000 pages, it is not that costly. So what they'll do is, like, they are doing all the PR activities. They are, promoting their products or promoting themselves in the annual report. So all of that is not required. So out of this 172 pages, lot of unnecessary information you will find. So first thing, before even reading the document, the first thing that I want you to do is go and check the contents here. You will find the contents in the document. You can see here so many things. First is about us. Okay. Our journey, GA1 to GA3, at a glance, our value creation model. So business, you can see this is all unnecessary. Future focused strategy. Everything is like a PR activity. Chairman's message is very important. Chairman's message is non-financial information. We have to go through chairman's message or managing director's message, MD's message. These two documents are, these two, 14 and 16. These two are important for me. Everything else I'll ignore. I'm not, keenly looking for that. What I'm looking is chairman's message, MD's message. That is non-financial information which will help me. I want to know what the MD thinks of the company. I want to know what chairman says about the company, like what happened in the last 1 year, or what he thinks will happen in the future. So those two are important. Board of directors, if you want to know who are the board of directors, that might help you. But rest of the information, stakeholder engagement, materiality assessment, or natural capital, awards and recognitions, I am not interested. This awards and recognitions, that is clear PR activity. I am not, I don't care what awards or what recognitions you get. I'm not really concerned about that. So that information I'll just ignore. So out of this 2 to 76, I am only going to place more emphasis on chairman's message and MD's message. So how much time is reduced here? So we have basically reduced all the noise, and we are only looking at the information here. So we don't need all of that. Those two pages are more than enough. So in the non-financial information, that is enough. And again, in the statutory reports, there is management discussion and analysis. This is also important, because end of the day, the management will help you understand what business they are in, what are the opportunities they are looking at, what are the threats they are looking at. So that will definitely help you, management discussion and analysis. Then comes the director's report. In the director report also, more or less what capital they want to spend, whether there is any plan that they are constructing, how much money they have spent. So that will also help. But business responsibility, sustainability will not help. Corporate governance report will not help. It is just copy paste. There is a template for that. Every annual report, every company is just copy pasting the information. So from 121 to 165, all those 45 pages, I don't even look at that. I'm not even interested because it's just copy pasted. The same template every company is following, just copy paste it in the annual report. So actually, that should be removed because it is a waste of time, waste of energy, if you ask me, because it is not substantial. I will not get to know anything about the company over there. But here, these two documents are, I mean, these two aspects, that is management discussion analysis, director report. This will help. So out of 165 pages, as you can see here, what is helping me? And this 165 pages, this is all non-financial information. What is helping me? Manager's, MD's message, chairman's message will help us. Management discussion and director's report will help us. Rest of all the things you can ignore. It won't help you. If you want to read them, I will not stop you. But if you want to efficiently utilize the time, then not required. This is more than enough. Then comes the financial statements. Now, of course, this is the financial information about the company. So in the financial statements, you will find standalone, you will find consolidated. Now let's try to understand the difference between standalone and consolidated. I'll take ITC as an example. So ITC is a good example. For example, many decades back, ITC is nothing but Indian Tobacco Company. Gold flag, all the cigarettes, is manufactured by ITC. Many decades back, ITC started as a tobacco company, started manufacturing and selling cigarettes. For quite some time, they were in the tobacco industry. So they made money, they were growing and all. But eventually they thought, okay, let's diversify into some other segments also. So from cigarette business is a standalone business for them. But later on, they started many other businesses. For example, they entered into hotel business. They entered into FMCG business. So FMCG, hotel are not related to cigarette, right? They entered into paper, stationery also. Classmate notebooks is actually is run by ITC. So you can see all these are different unrelated businesses, and they are all standalone. But since they started tobacco as their first business, tobacco is considered as standalone business. You include all these businesses, tobacco plus FMCG plus hotel plus stationery, that is a consolidated business. Now you tell me, if I am analyzing ITC, should I only look at cigarette or should I look at the entire business? Because they are not just making money from cigarettes, they are making money from classmates' notebooks, they are making money from hotels, they are making from Ippy noodles. So should I look at only cigarette or should I look at all these other business also? So obviously we want to look at every business. So if you ask me, should I go for standalone or consolidated? Any given day, I would say go for consolidated. Because in consolidated, you will have entire business. Standalone is only one part of the business, which will not help us. Consolidated is going to help us. So what we are going to do is we are going to look at consolidated financial statements for any company. Once in a while, a business might be operating in only one segment. Such business will not have consolidated statements because two or three different businesses, if they have, there is a requirement for consolidation. If they only have one business, then that one business itself is standalone. Two businesses, if they have one plus one, that is consolidated. So some companies you will only find standalone numbers, but majority of companies you will find consolidated also. If you find consolidated, go for consolidated numbers, not for standalone. Before reading the consolidated numbers, you will find the auditor's report also. That is also non-financial information. Auditor's report will also help you. So I hope you understand. I hope you understood the exact template of an annual report. There will be non-financial information. There will be financial information. In the non-financial information, you will find all the noise. Most of the unnecessary details you will find in the non-financial information. Mostly financial information, you will not find anything useless. Everything is useful, but the first part, non-financial, most of the useless parts you will find. Now 172 documents, sorry, 172 pages. Before even reading 172, the first thing that I'll do is I run few queries here. So you can see the magnifying glass here. I can use the keywords here. For example, I want to know whether there are any qualified opinions from the auditors, any adverse remarks from the auditors. That is the first thing that I want to know. If there is any qualified opinion, adverse comments and all, I mean, definitely I'll not, feel very confident investing in that stock. I may discard it as well. So first thing is I want to check qualified opinions. So here you can see the secretarial audit report is self-explanatory, and here you can see uh, does not contain any qualification, any reservation, or any adverse remarks or disclaimers. So except for there is one thing, except for delay in submission of disclosure on related party transaction. That is also in September 23, 2023. What happened was they have to submit the disclosure for related party transactions, and they delayed it. And they delayed it by 1 day. So 1 day delay I can ignore. That is not, it's a disclosure that they have to make and they delayed it for 1 day. That I can ignore. That we can ignore comfortably, but that is not a big issue. 1 day delay. If they have not provided, that's an issue. 1 day delay is fine, but of course they shouldn't have done that, but it's okay. So after looking at the auditor's explanation on the adverse remarks or qualification, we can clearly see there are no reservations, no qualified opinions, no adverse remarks. So done. First thing is good. Next, whether they have resigned. I mean, I want to know like how many resignations have happened. So you can see that no independent directors has resigned. So no resignations. So no independent director has resigned. You can see that here. And next, so I mean, this company doesn't have any pledge. 1 second. One second. Let me download this and open the download. 1 second, guys. Let me download this file. So this is the same document. I've just downloaded it. So here I can search for resign. So no independent director has resigned, as you can see. So next what I can search for is, let's say, pledge, whether they have any pledge. So you can see uh, out of total investment of the company, the shares of Unison. So this is not the pledge from the promoters. They have some other subsidiary company. In that subsidiary company, 51% of shares are pledged with PNB Investment Services. So, and they have taken a loan security against the rupee term loan. So this is not promoter's pledge. So what I am looking for is the promoter pledge. Did the promoters of the company pledge any shares? But the information about some other, company that they have some investment in that company there was a pledge. So that is not impacting Mahanagar Gas in any way. So again, the same pledge. So as you can see, the promoters have not pledged any shares. So what I do is initially I run these queries. So after looking at the initial searching, I realized, so auditor's opinion is I mean very clear that there is no adverse remarks, no qualifications and all. So now let's look at the balance. Let's start with the balance sheet analysis now. So now let's start the actual analysis part. So this is consolidated balance sheet. There will be, like I said, there will be standalone balance sheet and there will be consolidated balance sheet. I am looking at consolidated, not standalone. So let's start with balance sheet, move towards income statement, cash flow statement, so on and so forth. So here you can see in the balance sheet, you will find 2 years of data. That is the current year data and the last year data. The most important, things that you should understand in the balance sheet is assets, liabilities, and shareholders' equity. These are the three most important components in a balance sheet. Now you can see this is the balance sheet of Mahanagar Gas. On one side you have assets. You can see here this is assets. On the other side, that is below, you have equity and the liabilities. So assets, shareholders equity and liabilities. Like I said, these are the three most important components. And here you can see so many line items, like in assets there are so many line items, in liabilities there are so many line items. So what to do? I mean, have to analyze it. Like I already said, if you are focusing on half, it becomes overwhelming for you. Looking at all these numbers, you feel overwhelmed. You don't know what to do with all the numbers. That is the reason I said don't focus on half. Focus on why. You should understand why you need to go through the balance sheet of the company. Why? Point is very simple. We want to know whether the company can meet its long-term obligations or not. And we also want to know whether the company can meet its short-term obligations or not. So simply put it simply, we want to know the financial health of the company, whether it is strong or weak. If it is strong, then we proceed further. If it is weak, we don't want to invest in company where the financial health is weak. We stop our analysis. Then and there we'll stop the analysis. We don't proceed. We don't want to waste our energy on every stock. Got it? Now let me do the financial analysis, financial health analysis of this company. If the company pass the financial health, only then I'll proceed further, or else I'll discard it. Got it? Out of all the line items, now what item should I check? Like I said, the objective is financial health. The objective is trying to understand whether the company can meet its long-term obligations or not. Obligations are nothing but liabilities. So by default, even though there are multiple line items here, the first thing that I want to focus is on the liabilities part. Nothing else. Liabilities is important. Within the liabilities, what I want to focus is on the debt of the company. How much debt this company has got. Because that is the long-term obligation. So assets, in the assets you have current assets, non-current assets. Current is nothing but any asset that can be converted into cash within 1 year. Long-term asset is any asset that is going to benefit the company after 1 year also. Long-term asset, more than 1 year. Current liability is nothing but any obligation that the company has to meet within 1 year is current obligation or current liability. Any obligation that the company has to meet after more than 1 year, that is long-term liability or non-current. So that is the difference between current and non-current. Now, if you look at the liabilities, because I want to focus on the liabilities first. So in the liabilities, this company doesn't have any debt. It doesn't have debt. But what this company has got is the lease liabilities. They have to pay lease. Lease is also an obligation. It is also like a debt. But it's not like the debt that they take from the bank. Of course, if you are taking debt from the bank, it's slightly different. But this company has got lease liabilities. They have to pay lease. For example, there is a building. You are taking that building for lease for next 10 years. Now you are promising the owner that you will pay him, let's say 50,000 rupees is the rent. I'll pay this much of rent for these many years. It is an obligation for you. So lease obligations is also considered as a liability, long-term liability or a short-term liability. So this company has got 117 crores, I think it is crores, yes, 117.83 crores of lease obligations. That is long-term. Short-term, you can see, short-term, that is current lease liabilities, is also around 23. So 117 plus 23, 147, around 150 crores. So lease obligations are around 150 crores. So that is the debt. You can consider it as debt because they have to eventually pay. So the long-term obligation is around 150 crores. Now, in generally, this company has got lease liabilities, but not every company will have lease liabilities. So it is with Mahanagar, it is lease. Let's say you are looking at some other company. They have got long-term debt, they have got short-term debt. So at least conceptually, let's try to understand it in the form of debt so that it will be easier for you. If you are looking at some other stock, it will be easier. So we are looking at lease liabilities, but whenever you are looking at other stocks, it can be short-term borrowings, it can be long-term borrowings. As simple as that. Now let's try to understand this. Consider this also as a borrowing, let's assume. Let's say this company has got 150 crores of borrowings here, which they have to meet. Is it high? Is it low? Or is it moderate? What do you think? 150 crores. If you look at absolute number of 150 crores, you feel like, okay, 150 is a very big number. 15 crores is also a very big number. 2 crores is also a very big number if you look at absolute terms. But whenever you are in the process of analysis, we don't look at those absolute numbers 150, 500, 700. No, you relate that number with something else. Only then you will get to a point where you form an opinion whether it is high or low. Without that comparison, without that relation, you will never get to know like whether it is high or low. With what we need to compare this 150 crores, with what we need to compare? Now, generally, what some people would think is, okay, let's compare it with the total assets. 7,381 crores, there is total assets. Let's compare it with that. Okay, 150 versus 7,300. But definitely it feels like a low number, right? 150 sounds low. But that's not the right way. Because whenever you are starting a business, let's say any business, let's say you want to start a business, you need capital. Let's say 1 crore rupees capital. Now that 1 crore rupees capital, you can source it in two forms, in two ways. Majorly you can source it from equity or from debt. Two primary sources we call them. What is equity? Your capital, your own money. Let's say I want 1 crore capital, but I have only 50 lakh rupees with me. That 50 lakhs is owner's funds, my funds. So that is equity capital. I need 50 lakhs more. I went to a bank and borrowed money. That is debt capital. So equity capital and debt capital. These two are, with the help of these two sources, you will get the actual capital. So here we are looking at debt capital, right? Lease obligation is also kind of a debt that the company eventually has to pay. If at all you want to compare, you should compare it with the equity capital of the company, which belongs to the shareholders. So here you can see 150, around 150. You need to compare it with not total assets, but with this 5,130. That is the, you can see, equity attributable to owners of the company. That is the equity capital. Here it is 5,130 crores. Now you tell me 130 versus 5,130. 5,000 crores is extra here. 150 versus this 130 also you take. 5,000 crores extra equity capital this company has got. So it is almost a debt-free company. 0.01 or 0.02 it will eventually, if you calculate that, It might be 0.1 or 0.01 or 0.2. So almost a debt-free company. Now you tell me, Mahanagar Gas, can this company meet its long-term as well as short-term obligations? Clearly you can see like this company doesn't have that much of obligations and the company's equity position is very good. On the top of that, what I also check is the cash position, how much current investments they have, how much cash this company has got. That you will find in the current assets. You see, this is the current assets. You look at the investments here. Like I said, these are current investments. Mostly you will, if you go and check this 8, we will go and check also. So you can see investments, that is 1018 crores of investments they have, which is current investment. Like I already said, these are current investments, which means they can liquidate within 1 year. Mostly they will be in mutual funds or FDs and all. So they can liquidate today itself. And tomorrow they'll have that 1000 crores in hand. So that liquidities, 1000 crores, you can consider it as cash. Next, cash and cash equivalents is 129 crores. That is also cash. Bank balances is somewhere around 296. That is also cash. So 296, let's say 300, 430, almost 1400 crores of cash this company has got on the balance sheet. 1400 crores. How much obligations? 150 crores. 1400 versus 150. Now you tell me, what is the financial health of this company? Their equity is 5000. Cash itself is 1400. Obligation is 150. Very clearly, this company can meet its long-term as well as short-term obligations. Now, how much? Since I am explaining it to you, it took some time. Now, let's say if I don't need to, generally when I am looking at, I don't need to explain it to anyone. So the first thing that I do is, okay, 117 plus 20, 117 plus 23. So around 150, what is the equity position? So equity is like, okay, 5000. Okay, done. Okay, done. This company can meet. What is the cash? Okay, 1000 plus this 400. Okay, around 1400. Okay, this is good. So it will take me 20 to 30 seconds. That is what it takes. Not more than 1 minute to understand the financial health. Now, to get a better perspective of what the investments are, that is note 8, right? So I may go and check. I am not going to check cash and bank balances because it is pretty evident that is cash. I want to know what are these investments. 1000 crores of investments they have. If I go and check this note 8, I will get to know the investment. So let me go and check note 8. Okay, 14. Okay, this is 7 and this is 8. You can see here. So investments in, this is non-current. You have to be careful. Non-current as well as current, you will find in the 8 as a note. So this, they have 95 crores of some investments, 95 something crores of investments in this 3 EV Industries Private Limited. That is around 95 crores. But we are not looking for this. We are not looking at non-current investments. We are looking at current investments. So here you can see current. We want to know those 1000 crores, right? So here you can see these are the current investments. So liquid fund, Bandhan liquid fund, liquid fund, liquid fund, liquid fund, liquid fund. I already mentioned like I also have some money in liquid funds. And someone asked me like, Vishnu, where should I put my money? I said, you can put it in savings account or better you can go and put it in some liquid funds. And in my case, in my portfolio, I am generating some 7.2 or 7.3% CAGR by investing in liquid funds. So most probably this Mahanagar Gas is also generating 7% or something like that, investing in liquid funds. So they have cash and they are keeping that cash in liquid funds. You can see all the liquid funds and all. Of course, there are some arbitrage funds and all, but mostly they are all liquid funds. So if I sell, let's say I have 5 lakhs in, let's say SBI liquid fund. I want that cash. I can sell it today. I'll get the cash, credited by tomorrow. It is T plus 1. So if they want 1000 crores, they can sell it today. By tomorrow, it will be credited in their account. So 1000 crores is considered as cash. So no risk here. But of course, you will only get to know that when you go and check the notes. And with this stock, after looking at the notes, we realized it is all in the liquid funds. Now, this is more than enough. To be very honest, this is more than enough. But we also have got our Excel sheet. So in the Excel sheet, you can do deeper analysis. For example, if you look at balance sheet, in the balance sheet, here also you can do last 10 years of analysis. 130, like I said, those are lease obligations I have already mentioned. So versus this 5,100 something. So you can see like what's happening. Investments, you can see 1,600. You can see that is investments, cash plus investments. So this is common form analysis. You can see the reserves are continuously increasing, which is a good news. So net block is more or less the same. Capital intensive, you can see it's a capital intensive, but the company is still maintaining more or less the same thing. So as you can see, you can do this common form analysis, you can do all of this, but what I would do is I don't personally, do in-depth analysis with every stock. Only if I'm getting suspicious. Like I am going to give company chances. Like I'm not going to discard outright. I'm going to give it multiple chances so that I have all these numbers. But with Mahanagar Gas, it is very clear that the financial health is strong. It is very clear, very evident. So for that company, I don't need a much, extensive kind of analysis. So what I do is, if debt to equity is less than 1 and if financial leverage is less than 4, that company can comfortably meet its long-term obligations. And if this interest coverage ratio is more than 8, that company can comfortably meet its short-term obligations. So just by looking at these three numbers, I realized, okay, it can very clearly meet its short-term obligations, very clearly meet its long-term obligations. That I can know from my Excel sheet or I can know it from the annual report. Now you decide. It is up to you whether you go and check that in the annual report and decide the financial health of the company, or you can just go through my Excel sheet. Also, you can decide. Basically, you are getting the same thing. Most of the time, I use Excel sheet, then annual report. So what I do is first I'll do it with the Excel sheet. Then I go and check, for example, uh, I want some details. Like I said, in the current investments part, I went and checked the note number 8. Then I realized they are all liquid funds. So first I check here in the Excel sheet. Then I go to the annual report. I check whether they are authentic or not, whether they are what I am expecting, I can find it or not. So that I'll do. So balance sheet is pretty simple with Mahanagar Gas. Like it's too obvious that the financial health is strong. So now let's proceed further. Okay, balance sheet is done, financial health is done. What else? Income statement is next. In the income statement also, the first question is not how to read it or how to analyze it. The first question is why I need income statement. What is the purpose? Purpose is very simple. I want to know whether the company is making money or not. Question number 1. Question number 2. Did it improve from the last year or not? Question number 3. Is it consistently making money or not? So these are the 3 questions. Is it making money? Is it improving? Is it consistently making and consistently growing also? So that is the objective for reading the income statement or profit and loss statement. Now let's try to find those answers here. Again with the income statement also you'll find 2 years of data, current and the last year. Now here you can see the total income is 7,000. Here it is also 7,032. But you can see slight improvement is there. But more than sales, whether the company is making money, because sales, every company sales number will be positive. Go and check any company, sales number will be positive. What I am more interested is the net profits of the company. I want to know whether the company is making money or not, indicates the net profits. I want net profits to be positive. So here you can see 1000, after all the, considering all the non-controlling interest and all, it is somewhere around 1272 crores. Did it make money? Yes, it made money. Okay. Did it improve from the last year? 788 crores was last year's. 1200 is this year's. Did it improve? Yes, there is growth. It improved. Question number 3. Is it consistently making money? That question obviously you cannot answer by looking at 2 years of data. 2 years of data is not enough. Consistency means 3, 5, 10 years. Only then you will get the consistency answer. For that, again, we have Excel sheet anyway. So in the Excel sheet, there is income statement worksheet. So you have 10 years of data here. Now let's see. From 2000 crores to 6000 crores. And consistently it is increasing. You can see there are some slight up and downs, but mostly the company improved its revenue number overall. So company is growing. And if you look at net profits, yes, these 2 years, you can see there is some drop. In the current year also, you can see there is drop. But overall, if you see, is it a loss-making company? There was not even a single loss. Every year it made money. Now the answer is yes, it is consistently making money every year. There might be some ups and downs, which is, I already said, it's a cyclical company. There might be some ups and downs, but it is making money. No loss-making years. So now to answer the question, it made money. You can see this company made money. This company improved from the last year, and this company is consistently making money. One more question. Now comes the growth related question. Is it a high growth company, moderate growth company, or a low growth company? Now for that we have growth here. Now you can see 17.5 is long term, 27.5 is very short term. So you look at all the numbers, whether it is short term or moderate term or long term, this company is generating more than 15% growth, which is what we look for. 15% is something that we look for. And this company delivered 15%. So it is a high growth company, and there is some cyclicality, of course. Slight and moderately cyclical but high growth company is what we are looking at. That is Mahanagar Gas. Did we get our answers? Anything else is pending? Mostly we have got the answers, right? It is making money, improving from the last year, consistently making and growing also. But margins is something that I should mention here. Like I already said, it's a cyclical company, so margins are all over the place. And currently, if you look at the current margins, 18.46. Now you see the long-term average is 25. So the current margins are lower, significantly lower than the long-term margins. So currently it is in the down cycle or in the up cycle, or peak of the cycle or bottom of the cycle. What do you think? Currently it is somewhere around the bottom of the cycle because significantly lower than the long-term average. So that is the position. Like why we are asking this question here, especially for Mahanagar Gas. See, one thing you need to understand, 25 is the long-term average. And for example, if this number is, let's say, 30, I would stop my analysis. I would stop and I'll not proceed further. The reason is, if it is at 30, long-term average is 25, that indicates the company is at the peak of the cycle. And obviously, eventually the margins will revert back again towards the average and even below. So there is a risk that I am taking. I invest, and after I invest, the margins will drop, the net profits will drop, the share price will also drop. So I don't want to enter into such businesses or such stocks. Whereas with Mahanagar Gas, the current margins are much lower than the long-term average, which gives me an extra confidence. As you can see, the sales are not dropping. 3000 to 6000 to 6600. The sales are not dropping. Only the net profits dropped. net profits dropped because of the margins drop. Of course, why margins drop, that I'll cover going forward. When I am valuing this stock, I'll give you all the reasons. But here I need you to understand that the margins drop, that is the reason net profits dropped. So looking at the history of the company, margins are dropping and going up. It is coming down, it is going up. So it's a cyclical, in a cyclical manner, it's happening. Now it is down, tomorrow it will go up. So now you see the confidence. Tomorrow the margins will go up. Since the sales are intact, the net profits will jump tremendously. And the growth rate will also be tremendous in the next 2-3 years. Instead of 15%, I may get 30, 40, 50% growth in next 3 years. So that is an added advantage for me here. So that what I have realized. Looking at the income statement, it's a cyclical company. Without a doubt, it's a cyclical company. But it's not something like a very, deep cycle. I would say like 30, 40, 50% drop. It's not that deep cycle. Cyclicality happens, but more or less the net profits may fall 20 to 30% range. We have never seen the drop for 50%. For example, you can see this a 22% drop, a 4% drop. There is cyclicality, ups and downs, but it's not like the company will go into losses if it is in the bottom cycle. That is not the case. So at this point, we are done with the income statement and we got our answers. We are looking for the mean reversion. We are looking for margins to improve. Now comes the cash flow statement. Now again the question is why? Because cash flow statement will help you understand how much cash came into the business, how much cash went out of the business. Now this sounds similar to income statement. Income statement also is telling me how much money came in, how much money went out. So if you go and check the income statement, you will realize the three most important components. First is the revenues. Next is the expenses. Next is the profits. Revenue, expense and profits. That is what the income statement is telling me though. So why there is a need for cash flow statement again? It's because of the accrual accounting. There is something called as accrual accounting. Now what exactly this accrual accounting is doing here is, for example, you are selling something. Let's say you are selling a pen. You are in a business of selling pens. Now what happens is, you delivered this pen to, let's say, a customer. According to this accrual accounting, if the product is delivered and you are certain that the customer will eventually pay me, then you can record the sales, you can record the expenses, you can record the profits on that day itself, irrespective of whether the customer paid or not, whether you received the cash or not. That is irrespective. You are certain he'll pay, you record. What if he doesn't pay? That is a risk. And where you will find this accounts payable, basically accounts receivable, that is what you will find in the balance sheet. So there is something called as accounts receivable in the balance sheet. So whatever the credit sales that you are doing, all that funds you will go and keep it in the accounts receivable. And simultaneously you will increase the sales of the company, you will increase the profits of the company without receiving a rupee in cash. That is the risk. The companies can show like high sales growth, high net profit growth, even without receiving any cash because of the accrual accounting. So that is the reason we need to check the cash flow statement. This company made, or at least reported, 1,200 something crores of profits. Now I want to know, okay, they reported profits, but whether the cash is received or not. If they don't receive the cash, that is paper profit, not real profit. They should receive that cash. That is the reason we are looking for cash flow statement. In the cash flow statement also you'll find three components: cash flow from operating activities, cash flows from investing activities, and of course cash flows from financing activities. Now in the operating activities, there are so many line items, but we don't need all of that. I want to know, this company mentioned some 1,272 crores they made as profits. That is the company reported. I want to know how much cash is actually generated. You can see 1,567 crores of cash. So this company actually received more cash. than they have reported. So it's a good news or bad news? Obviously, cash is always a good news. Cash coming into the business is always a good news. So definitely, like, this company is narrating the same story. Sometimes what happens is income statement might be narrating a different story. Cash flow statement, you will see a different story. But here they are in line. Cash flow statement also they have cash. Reported also they have cash. For example, last year they have reported 788 crores of profits. And you can see in the last year they generated or they received 900 crores, 970 crores of cash. So again, more than what they have reported. So it's a good news. This company is generating cash. And here you can see property, plant and equipment. Property, plant and equipment. Basically, this is the capex. This company is spending 783 crores in cash, in capex. Here 713 crores in capex. So as you can see, that is what the company is spending. Purchase of current investments. So you can take a net figure. You will get an idea. Okay, this is what 6,500. Okay, this is current investment. So I don't take current investment seriously because that is all we have already checked. Liquid funds. So they are doing a lot of churning in the liquid funds. So, but this is very important. 780 something is their capex. Next is proceeds from sale of borrowings. You can see repayment of loans. So lease the obligation. So you can see mostly it is dividends payout. So you can see the biggest here is the dividend payout. They have some borrowings, but they repaid all the borrowings. So here dividends is actually the significant part because they are not paying any interest. Interest is also not that much. They don't have a lot of debt. So the biggest line item here is dividend. So like I said, why I am looking at the cash flow statement again, two things I want to know as an investor. One, whatever the company mentioned in the income statement, profit and loss statement, whether that is reflecting here or not, whether the company is narrating the same story or not, that is what I want to know. With Mahanagar Gas, the company is narrating the same story. So nothing to worry. So it is in line. Cash flows and net profits are in line with each other. And here you can see. So this is the cash flow statement you will find in the Excel sheet. So here you can see. First question is what are the major sources of cash for this company? There are three sources: operations, investments, or financing activities. But Mahanagar Gas, you can see cash flow from operations is the major source. So this company is generating cash from operations, which is good news. And green, you can see investing. Out of whatever they are generating, most of it they are using for investments. Capex itself is almost 700, 800 crores. You can see this is the capex. 700 something, 700, 800 they are utilizing for capex. So biggest chunk they are using for growth, further expansion. And 200, 300 crores they are paying as dividends also. This red is dividends. So they generated some 1200, 1300, 1500 crores in cash. Out of that, 700, 800 is spent for capex. 300 something is spent for dividends. So as you can see, that's how they are doing it. Next is whether the CFFO is sufficient for capex. Obviously, like you can see out of 1500, only 800 is their capex. Remaining 700 is free cash flow. So obviously they can meet comfortably, they can meet their uh, capex requirements. Next, this is the most important: whether net profits and cash flow from operations they are in line with each other or not. Income statement and cash flow statement narrating the same story or not. You can see here they are absolutely in line with each other. In fact, in most of the years, or actually if you carefully observe, 10 out of 10 each and every year, cash received is higher than the reported profits. We call it as quality of earnings. Mahanagar Gas quality of earnings is top notch. Without a doubt, top notch. So that is cash flow statement. So far, what we have done is, or let's say I'm looking at 5,000 stocks. From 5,000 I reduced it to 500, then I narrowed down to Mahanagar Gas. I liked it, then I downloaded the Excel sheet, then I downloaded the annual report. Simultaneously I'm looking at the Excel sheet, I'm looking at the annual report. If I have any doubts, I'm trying to clarify my doubts with the help of annual report, so on so forth. I'm done with financial health, which is strong. Income statement, which is favorable. Cash flow statement, again, reported profits are true because cash is also received. So far, so good. Now let's get into the Excel sheet part. The next thing that I want to know is financial health is good. Growth is also good. Cash flows is also good. What about the profitability of the company? Because end of the day, profitability is what matters. If it's a high profitable company, only then we'll invest. If it's a low profitable company, we are not interested. Even though the margins of Mahanagar Gas were fluctuating a bit, but if you go and check the profitability of the company, you will see absolute consistency. It is a high profitable company throughout. Look at the last 10 years of data. Every year, return on capital employed, this company generated more than, close to 30% average. Return on capital employed, not 15%. We look for 15%, right? But this company generated more than 30%, almost 30%. So absolute high profitability. But now I want to know what is the reason. So what is driving that profitability? Let's do the dew point analysis. So when I say profitability, I look at two things in terms of profitability. One is the quality of that. I want high quality profitability, and I want high quality quantity profitability, quality as well as quantity. I look at both, and I want to know what is the quality and what is the quantity of Mahanagar Gas. First, let's try to understand the quality using DuPont analysis. DuPont analysis is nothing but we are looking at return on equity, but we are trying to understand what are the key drivers for that return on equity. If you look at the formula is very simple. Net margins into asset turnover will give you return on assets. Return on assets into financial leverage will give you return on equity. So if you look at Mahanagar Gas, for example, in 2024, if you look at the current net margins are 20.6. Asset turnover is 0.9. You multiply that, you will get a return on assets of 17.84. This return on assets is very important because return on assets will help me understand the quality of the business. I want this to be more than 8. 10 is great, but minimum 8 is what I am looking for. If the company doesn't have minimum 8% return on assets, then I don't feel like investing. 8 is minimum requirement. And here you can see consistently every year it generated more than 8. So high quality profitability, and long term average is also around 15. 15% return on equity I am looking for, but this company generated 15% return on assets itself, like more than 15%. Now if you multiply this with the financial leverage I don't want more than 4. I want it to be less than 4. If I multiply it with this, it ended up as 25% return on equity. So what you have realized is, if this number is very high, then it can be boosted. Return on equity can be boosted. Let me show you. 1.41. What if the financial leverage is 3? You can see return on equity will be 53. What if the financial leverage is 5? You can see 89. But 5 is risky. So by increasing the financial leverage, you can boost the return on equity. But with that boosting, risk is also attached. High financial leverage, high risk. So as long as the financial leverage is less than 4, I am okay. But if it is more than 4, I am not interested because the return on equity is boosted by high leverage, which is not something that I am looking for. At least with Mahanagar Gas, I am trying to understand the quality of the profitability. And what I have realized is return on assets is top notch. Return on equity is also top notch. So high quality profitability. Quality side, I got the answer. Now I want answer for the quantity side. And one more thing, if you try to understand what is the key driver for this return on equity, you will realize the key driver is not asset turnover. Asset turnover is moderate. The key driver is actually the margins of the company. High margins is what driving the return on equity. So pricing power, this company has got pricing power. It will help you. Why I'm saying pricing power, why I'm mentioning this, you will get to know it eventually. That will be used somewhere else. This is asset use efficiency. This is pricing power. In the economic modes, you will understand that. This company has got pricing power. So quality is done. Now let's look at the quantity aspect of the business. Have to calculate the quantity. For that, we use something called as free cash flow to sales. Concept is very simple. Out of 100 rupees sales, how much money the owner is able to keep it in his pocket? I want minimum 5 rupees. 100 rupees if he is generating, the owner should be able to put 5 rupees in his pocket and take home. That is the cash generating capacity of the business. So that is what we call as uh, quantity side, like high quantity, minimum 5%. So free cash flow sales, you can see here, long-term average is what I generally look for. Not 1-2 years. 1-2 years it can fluctuate, but if you look at the long-term average, you can see except for this year, every year it generated more than 5%. In fact, 10, 13, 16, 14, even if you look at the long-term average is 11%. 5% is okay. This company long-term average is 11%. So you can clearly see free cash flow is more than 5%. Return on equity is also more than 15%. So both quality as well as quantity are good. So high profitability, not just high profitability, high quality, high quantity profitability. Now let's try to understand the profitability matrix here. Now there are 4 types of companies you will find, or a company can fit into any of these matrix. 4 types. First thing that you understand is there is a less risky company, there is a high risky company. Less risky and high risky. These are great companies. Less risky companies are great companies where you will find the return on equity is more than 15, free cash flow sales is more than 5. That's a great company. High quality, high quantity profitability, that's a great company. Look at Mahanagar Gas. Free cash flow to sales is 11%, return on equity is more than 15%. So Mahanagar Gas is a less risky business. Less risky business. And it's a great company. It falls into the category of great company. I am not doing this for the sake of doing it. You need to understand, less risky, great. We are going to implement this in the valuation process. Everything that I am covering here, you will see it reflecting in the valuation. So pay attention. I am not saying this for the sake of saying it. Everything will be reflected in our valuation. Got it? So less risk. What about high risky companies? Return on equity will be less than 15%. Free cash flow to sales will be less than 5%. They are worst companies. Generally, we don't invest in such worst companies. So discard these companies. More than 90-95% of investors go and buy these worst companies and end up losing money. So please avoid them. Then we have the gray quadrant where the return on equity is less than 15, but free cash flow sales is more than 5. Low quality but high quantity. Should we invest or not? Good ROE but good free cash flow but bad ROE. These are mostly declining businesses. Return on equity is declining, but since they are declining, they are liquidating assets and also cash flows they are generating. No. If you ask me out of free cash flow to sales or return on equity, which is more important, any given day I'll vote for return on equity. Because if the free cash flows to sales are low, then what does that indicate? The company might be investing in capex, expanding the business, maybe buying a land, plant, machinery, equipment, expanding the business. And if the return on equity is high, then what that indicates is the company is reinvesting and generating high return, which is also a good news. So I'm okay with low free cash flow, but I'm not okay with low return on equity. I want return on equity. So I am going to avoid these two. Good free cash flow to bad ROI I avoid. Worst companies I avoid. What about this? These are emerging companies. Return on equity will be more than 15, but free cash flow sales will be lower. Sometimes negative also. But I am okay. As long as the return on equity is good, I know that they are reinvesting and they are generating very good profitability. So I am okay with it. So I invest in emerging business also. I am okay with it. So these two great companies and emerging companies I am okay investing. These two I avoid. I'll not invest in them. Whereas Mahanagar Gas, with Mahanagar Gas, it is a great company. So remember that Mahanagar is a great company. Now comes the economic modes of the business. As you can see, I am not using any kind of PPTs or any of that because I want to help you in terms of practicality instead of showing you all the PPTs and all. But I'll discuss. I'm discussing everything, but I'm taking you through Mahanagar Gas. So now we have reached the economic modes part. I want to understand whether this company has got any moat or not. What exactly is moat or what exactly is competitive advantage? Once upon a time, kings would live in castles, and these castles would time and again attacked by enemies. So what they would do is to protect themselves from these enemies, they would dig a wide moat pit around them. Okay, wide moat we call it. So deep and wide pit around the castle. Fill it with water. Throw in all kinds of deadly creatures like piranhas, crocodiles, sharks, whatever, so that the enemy won't be able to cross it. So that's how they used to protect the king's castles. Today we don't have king's castles, we have business castles. We need such wide, deep moat around a business so that the profitability is protected. Look at Mahanagar Gas. 20, 25, 30% return on capital employed. Capitalism is pretty brutal. You show them the returns, the capital will flow. Looking at such high returns, someone else can also start the same business and steal profits from this company, market share from this company. There is a possibility, right? But this company has got some kind of a moat. This company has some kind of an advantage. How do I know that? Any business generating more than 15% return on equity or return on capital employed consistently for last 10 years, that itself is a proof. This company has got some kind of an economic moat. What it is? Before getting to know what it is, we need to understand what kind of economic moats are there. There are only four kinds of economic moats. One is something like intangible assets. Now, what are these intangible assets? It can be brand, it can be copyright, it can be patent, it can be regulated licenses. Intangible assets, it can be brand, patent, copyrights, some regulatory licenses, so on and so forth. So these things, for example, there is a patent. What is a patent? It's an exclusivity provided from the government that no one else can copy your product or formula or whatever it is. No one can copy for 5 years, 10 years, 15 years. So that's an exclusivity. This company will get that exclusivity, and that is an advantage. Regulatory license, no, only the person with the license can do this business, no one else can do it. Now if you look at Mahanagar Gas, this company has got regulatory licenses. Of course, there is switching cost also, there is network benefit also, there is low cost advantage also. But if I look at Mahanagar Gas, what I realize is this company has got pricing power based moat. Switching cost, network based advantages, intangible assets, these are all pricing power moats. Whereas low cost advantage, you will see that reflecting in asset turnover of the business. If you look at the asset turnover, this company asset turnover is not that great. It's moderate, but majority of major driver is actually the net margins. So this company has got pricing power based mode. In pricing power, what we have? Network benefits. This is a I mean, gas distribution company in in Mumbai and somewhere around across Mumbai. So gas distribution, what kind of network benefits they have? Very few, right? So I don't think this is a network benefit kind of thing. Switching cost, of course, they are distributing like CNG, LNG, and all. But what exactly would be the switching cost? Maybe they have that pipeline and all if they have. So what exactly is the switching cost? Do they have regulatory license? For example, do they have any patents? Copyrights? I don't think so. Do they have any regulated licenses? Think about it. Do they have any regulated licenses? Like I said, this is CNG, LNG, PNG. Obviously, that is a heavily regulated area. Not anyone and everyone can go and start a gas distribution company. Government licenses are required. So this company is having that kind of a regulatory license. Only few companies have got the license. Only they can do it. So Mahanagar Gas major moat is the regulatory license. Apart from everything, that is the major moat. Not networking benefits or not copyrights or not patents or not brand. This is regulatory license based moat. Now, do this company has got any pricing power based moat? Intangible assets, I am putting it because in the intangible assets only we have got regulatory licenses. Then this company has got any cost based advantage? No. Asset turnover we have already seen, not that great. So cost advantages, no. And the company's margins are also fluctuating because of the cost base. This company doesn't have any cost based mode. Of course, there is one cost based mode which I'll mention. Yes, this company has got unique. It's not economies of scale. So I am keeping it as cheaper process. But this company's cost based advantage is not actually cheaper process. But the government subsidy they are getting. Government is allocating them gas at a cap fixed. There is a cap price. Only below that they are getting allocations of gas. So yes, there is cost based advantage, but it is not because of their business model, because of their operations. Whenever I say cost based mode, I mean to say the business has got some kind of an advantage. They have some process, they have some unique abilities, they have some manufacturing capabilities, so they are able to get that cost advantage. With Mahanagar Gas, it is not because of them they have the advantage, it is because the government is allocating them that gas at a floor price or at a cap price which is very low. So they have cost advantage because the government is providing that, whereas regulatory license that is also provided by the government. Got it? So the major moat is regulatory license. Because of that license, they are able to get the gas also at the cheaper price. So both you can see. But I don't place more emphasis on cost-based advantage because that structure is changing eventually. In the valuation, I'll mention that. Where I am put whatever I'm saying right now, whatever I am pointing out, everything you will find in the valuation. Like I said, I am not doing anything for the sake of doing it. Everything you will find in the valuation. Let's go towards valuation. There you will realize. So, what is the strength of the moat? Wide moat, emerging moat, narrow moat, no moat. As of today, see, things change. Going forward, things might change. So, as the information changes, my opinion will also change. But at this point, as of today, this company has got wide moat, very strong moat. As of today, if things change tomorrow, from wide moat, maybe I would take it towards narrow moat, towards no moat. So whatever I'm mentioning here is not like a print or it's not a seal. With every company, information changes. And with the changing information, we change our opinions. So whatever I'm mentioning as of today, what I feel. And I'm going to track this company going forward. If it is intact, I'm going to continue the same opinion. If it changes, I am going to change my opinion. Got it? So this is as of today, whatever information, whatever understanding I have, I think this company has got wide moat. Then comes the competitive advantage period. How long this company can, actually maintain this competitive advantage? How long? The duration. So again, there is a matrix here. So two things you need to understand. One is company strategy. The other is the industry structure. Either company strategy or the industry structure, both will help you understand the longevity of the moat. Now, longest gap you will find in companies where the company has got a favorable strategy and it is in the favorable industry. That company longevity is good. Long gap. Here the company strategy is favorable, but industry is unfavorable. There also will get long cap. Short cap, industry is favorable, but company doesn't have any strategy. Shortest cap or no cap, I would say, no moat. No strategy, industry is also unfavorable. Now you tell me where you should never invest. This is a place you should never ever invest. Outright avoid. Because no moat, no industry, industry structure is also not favorable. So avoid this outright. What is the best? This is the best. Longest longevity. Longest is the best, right? Company strategy. If you look at the strategy of Mahanagar Gas as an example, this company has got regulatory licenses. So that is the moat. So there is a strategy. Regulatory license itself is a strategy. And because of that regulatory, that thing, the company is getting allocations from the government at a cheaper price. Allocation of CNG, LNG, PNG and all, they are getting at lower prices. So as you can see, there is a strategy here. The strategy is favorable. So there is a moat. What about the industry structure? Of course, industry structure, there are many aspects like the intensity in rivalry intensity or bargaining power of supplier, bargaining power of buyer, so on so forth. Value migration or threat of new substitutes or entry barriers. There are so many things you can look at. But I always use a shortcut for that. So what is the shortcut? Let me show you 1 second. So this is Mahanagar Gas. I hope the screen, okay, it's sharing. So what I do is I go to peers and I see like what is the profitability in the industry. If the overall industry profitability is good or more than 15%, then I consider, okay, it's a favorable industry. If the overall profitability of the industry is bad, then it's an unfavorable industry. And you can see gas distribution. That's what this business is in. Mahanagar Gas is into distribution, gas distribution company in Mumbai and Raigad, closer to Mumbai area. It's a district, so mostly it is in Mumbai and Raigad district. And you can see the industry participants focus here. The long-term return on capital employed. 10 years is what we are looking at. 25.63 is the median. So not just Mahanagar Gas. Indraprastha Gas. Regulatory licenses, top-notch profitability. Gujarat State Petronet, top-notch profitability. Petronet LNG, top-notch. GAIL is also somewhere around 15 only. It's not bad. It's somewhere around 15. So except for GAIL, close to 15, everyone else is generating like more than 20, 25, 30%, like almost in between. Average is somewhere around 25. So you tell me now, gas distribution companies, is it a favorable industry or unfavorable industry? What do you think? Clearly, it's a favorable industry, right? So now you tell me, Mahanagar Gas has got a strategy which is favorable and industry structure is also favorable. So it falls here, right? Longest cap. So if you ask me the competitive advantage, I would say this company's longevity is good. Then comes the growth advantage period. I want to know like how much growth this company can generate. So highest PAT growth, where you will find it? The company should have like high growth mindset. The industry should also have that potential of high growth industry. So if mindset is high, industry growth is high, then the highest PAT can be generated. High PAT is also okay. So if you ask me, I'm okay investing in these two companies. If the company has got strategy, I'll invest. Industry is favorable or not, that is secondary for me. For me, company strategy moat is important. With Mahanagar, there is favorable industry also. I'm happy for that. But if not, I'm okay with this also. And similarly, if you look at high PAT growth, company growth mindset is very important. Low industry growth will also generate high PAT growth. Lower PAT, company doesn't have growth mindset, but industry growth is good. So I'm not going to look at industry growth. That is the reason people ask me, what do you think of EV? What do you think of solar? Industry is growing, but I'm not looking at industry. Company should have growth mindset. Within the industry, company growth mindset matters. So if the company doesn't want to grow, EV or solar or whatever driverless cars, company won't grow. The management should have that growth mindset. Lower PAT, where you will find it, no growth mindset, low industry growth. So that's where, so outright we avoid this. Outright. This we are not really interested. These are okay. These two are okay. And if you ask me, what about the growth mindset of Gujarat Gas? As you can already see, they are investing 700 crores last year, 800 plus crores this year. So they are constantly reinvesting. They are expanding. What else is that? Isn't it growth mindset for you? And isn't it reflecting in their numbers? Look at the sales growth. Look at the net profit growth. So it's reflecting. They are reinvesting a lot and they are generating high profitability on that. They are generating profit growth. Isn't it visible clearly that this company wants to grow? So growth mindset is clearly visible. So this company has got high growth mindset. But what about the industry growth rate? Again, what I'll do is I go and check the industry peers only for that also. So here you can see 5-year growth is somewhere around 18-19%. 3-year growth is somewhere around 15%. So profit growth of 7 years is somewhere around 17%. So you can clearly see 3-year or 7-year or even 10 years also you can see. Overall, industry average you can see like it's more than 15% or around 15%. So what I would consider is it generated high growth. This company generated high growth so far. It may generate moderate growth because it is somewhere around 15-16. So next 10 years it may generate 12-13 because generally slowdown happens in every industry. So if not high growth from here on, the company might generate at least moderate growth. It will not generate low growth. Low takes time. From high, maybe it might shift towards moderate growth. So it may not generate highest PAT, but it may not generate high PAT. It will be somewhere in between, which I am okay with. I am okay with. But I'll still consider Mahanagar to generate highest PAT only because they have got growth mindset. Industry growth is also not very bad. It is 15, 17, 18 long term. Maybe in the next 10 years, if you look at the growth rate, somewhere around there only. So I'm giving it the benefit of doubt. I'm considering it as highest PAT only. If not highest, it might generate somewhere 1-2 percentage points lesser, but it's not going to generate 5% or 6%. It will still generate more than 15% is what I'm expecting. So you just combine them. Moat growth advantage period. So Mahanagar Gas fits into true wealth creator. High growth, there is high moat. So this can become an enduring multi-bagger. If bought at the right price, valuation matters. Bought at the right price, it will be a multi-bagger. What is growth trap? Some companies have high growth, but their moat is absolutely weak, pathetic, no moat. Those companies will become transitory multi-baggers. That is, they go 5x, they generate 10x, but they'll fall. There is no sustainability. They'll not endure. They'll fall. That is growth trap. There is quality trap. High quality companies, for example, Castrol, something like that. 100, 70, 80% return on capital employed, return on equity. But go and check the growth rate, 3% growth, 4% net profit growth. Quality is good, but no growth. So they'll underperform. They don't generate much returns. Next is wealth destroyers. Low growth, weak moat. Obviously, you will incur permanent loss of capital if you invest there. So avoid wealth destroyers. They won't help you. Avoid quality traps. You will not generate any returns. So there is opportunity cost. So avoid quality traps. I am looking for what I am looking for is true wealth creators, enduring multi-baggers. But once in a while, I go and invest here. I know, I understand this is moderate risky. This is low risky. This is some moderate risky. So you have to buy at the right time. You have to sell at the right time. If you don't exit, the share price will fall. Mostly, this is what I would call as the extreme mean reversion kind of investments. Like what I am looking for is the reversion in the cyclicality. Right now, the cycle is at the bottom, but the company is always profitable. Sales are intact. There is a possibility for margins to revert back, which will influence the net profits growth, which will influence the share price growth. That is a transitory multi-bagger. I know it is not moat. It is only improvement in the margins, and for that period, the stock will explode, and I get that again. I have to sell because anyway, eventually margins will fall again. It's a cyclical company, right? So there also I invest. I take moderate risk. So there also I'll invest, but my focus area will be the enduring multi-baggers. Mahanagar Gas is a enduring multi-bagger, so true wealth creator in this matrix. So that is where it falls. Now you see, I think I have covered many things here without showing 100 PPTs within this one two worksheets only. I have covered most of the analysis part. Balance sheet is done. Income statement is done. Cash flow statement is done. Profitability is done. Economic moat is done. Industry analysis is done. What else is left? Let's try to understand the managerial part. We need to understand the management also, right? So what I personally do is, I mean, when I started my investing like 12 years back, so the toughest part was understanding the management because I had no framework. I don't know anything about the management. Of course, we don't have access to meet them. So it was initially very difficult for me to like have to analyze the management. Like I don't have a proper process. Then eventually I realized, I mean, after reading many books, I read uh, this book, that is the little book that builds wealth, which is from Pat Dorsey. One more book from him, the five successful rules for stock investing. In this five rules for successful stock investing, he mentioned a framework. So he said you divide the management analysis into three parts. One is compensation, one is character, the next part will be operations. So compensation and character are more or less the same. So what we are trying to do is we are trying to understand like how much the management is taking as remuneration and whether they are trying to just get benefit out of the company, or they are working for the overall benefit of the company or for themselves. That question you can answer by looking at the payment, like how much remuneration they are charging. So let's try to look at the remuneration of uh, Mahanagar Gas. Remuneration, okay. Secondment charges also including key managerial per after. Okay, actually, I wanted to search more uh, and get detailed numbers. But now looking at this, I don't feel like looking at detailed numbers because it said secondment charges. It said also included key managerial person's remuneration also is included here, which is 2.4 crores. So 2.4 versus what is their net profit? 1200 or something like that, 1000. Now, rule of thumb is less than 5% is okay. Now, I shouldn't say 5% because 1000.05, that is, this company can take up to 50 crores of remuneration. The top manager can take 50 crores of remuneration with this 5% rule. But he is charging 2 crores or 2.4 crores. So, we shouldn't let them know about this 5% rule. Maybe they'll start taking 50 crores then. So it is, they are being very reasonable, right? Only 2.4 crores, which is reasonable. 1000 crores of profit, only 2 crore remuneration. So they are in line with our expectation. So compensation is very minimal or very reasonable. And one more thing, 1 second. So yeah, you can see promoters. Okay, Gale India is the promoter. So government has got some 10% ownership here. And Gale is also a government company. So yeah, I just try to understand like what ownership they have got. So okay, like remuneration is pretty reasonable. So character compensation, like both are in line with each other. So just by looking, they have no pledge. They didn't pledge any shares. Uh, and as you can see, I've gone through the revenue recognition already. So revenue recognition policy is also very good. I mean, no suspicious. I mean, it's not suspicious. It's fair. Then what else? No pledge. Then we have checked the remuneration. Remuneration is also very reasonable. So compensation character, I think that clarifies my doubt. Now comes the operation part. Now operations, what should I say? I have whatever I have done so far is the operations only. Like high profitability, high growth, strong financial health, great cash flows, economic moats. It's a great company, longevity, high growth mindset. So what should I say? Like management quality, it's high quality management. What should I say? Like I didn't find any red flag so far. So management is also top notch. Now what else we have? Like so we are left with the valuation part. So far, whatever we have covered, whatever aspects we have covered so far, every aspect indicates that Mahanagar Gas is a high quality company. Without a doubt, it's a high quality business. But even if it's a high quality business, I want to pay reasonable price. If the price is not reasonable, I'll not invest. I may keep it in my watch list. I will take this company and keep it in my watch list. and wait for the right time. And whenever that right time arrives, maybe then I'll go and buy. Now I have a question. Now my simple question here is, okay, it's a great business, no doubt. If at all I want to invest or I have to recommend, I need a good price. Now we are at that point of trying to understand the valuation. Now let's try to value Mahanagar Gas. Now here, there are two ways I can value. One is relative valuation. The other is intrinsic valuation. In the relative valuation, you can see there are 5 different types of metrics here. But the most important thing that I look for any stock is the P ratio of the stock. Price to earnings ratio comes first. Remaining all are just supporting ratios. Price to earnings is the most important parameter for me. Remaining are just supportive. So here you can see the price to earnings ratio is 11.58. Again, just 11.58 might not help you. Undervalued, underpriced or overpriced. So what we can do is, as the name suggests, it is relative valuation. So in relative valuation, we have to relate that with something else. With what you want to relate. You can relate this with the overall market index, like Sensex or Nifty or something like that. You can do with the overall market and you can compare it. Let's say the current Nifty is somewhere around 20p, 21, something like that. Current Nifty P. And here it is 11p. So you can see based on that is undervalued. Or instead of looking at overall market, you can go and check the industry P. Compare it with the industry P. So what exactly is the industry P? So industry P is 17.32. Industry P is 17.32. What is Mahanagar Gas P? 11.5. 17 versus 11. So based on market also it is cheap. Based on industry P also it is cheap. But I don't check industry P or I don't check market P also. I don't follow that process. Of course, Mahanagar is cheap if you follow that also. But the session is not just about Mahanagar. Mahanagar is an example. If you are practically implementing this with any other stock, remember, I don't check market PE with this. I don't check industry PE with this. What I do is I use the historical PE ratios of that company itself. Because if I check Sensex or Nifty, there are 5,000 stocks, or let's say Sensex 30 stocks, Nifty 50 stocks. Those 50 stocks, there are banks, there are IT companies, there are cement companies. How you can take the mix of all those companies and compare a gas distribution company? So it's not in line with it's not consistent. Chalo, you can say, okay, in the gas distribution industry itself, they're all in the same business. You can compare them. No, because within the industry, some company can be a high growth company. This can be a low growth company. So their growth rates are different, depreciation rates are different, tax rates are different, their debt levels are different. So when everything else is different, how can you say they are apples to apples or oranges to oranges kind of comparison? How can you say that? So they might be in the same industry, but I don't think they are comparable to each other. So what I personally do is I take that company's long-term P ratio average and compare it with the current P and conclude whether it is high or low. And you can see with Mahanagar, 3-year is 11.9, 12.9, 15.7. So basically 11.58, which is lower than all the averages. Lower than 3-year, 5-year, 10-year average. So as you can see, based on the P ratio, Mahanagar Gas seems cheap. That is the reason you see this smiley face here, or else you'll see such sad face. So you can see it is cheap based on PE, but there is a catch. Why we are doing this relative valuation? We have to start with, before getting into valuation, we should always start with why. Why we are doing this valuation? There are see, I have 10 lakh rupees. I want to invest in a stock. I want to generate return. Let's say 15% return I generated. That 15% is total return. But in that 15% total return, there will be speculative return. There will be investment return. Investment return is generated through improving or deterioration of the fundamentals and the dividends. That is investment return. Speculative return is generated through the change of P ratio. If P ratio increase, speculative return will be positive. If P ratio drops after you invest, speculative return will be negative. So as an investor, I want speculative as well as investment return both to be positive, and I want it more than 15%, minimum 15%. With Mahanagar or with any stock, I don't pay more than 20 PE because I believe if you pay more than 20 PE, the potential for speculative return or high speculative return is gone. In fact, most of the time you will generate negative speculative return if you pay high PE ratios. So here you can see what I want is less than 20 PE. That is the first thing. And of course, then I check with the long-term averages. Then I want to connect this with the growth rate of the company. Remember this. High growth companies deserve high PE ratios. Low growth companies deserve low PE ratios. If Mahanagar Gas generates, let's say, 5% growth, only 5% growth, then is it okay for you to pay at least 11 PE? No. We call it as PEG ratio. You compare the price to earnings of the company with the growth rate of the company. Let's say the P ratio is 11.58 and the company is generating 11.58 growth, then the PEG ratio is 1. You can invest. PEG ratio is 1, you can invest. If it is 11.58, but growth rate is, let's say, 9 or something like that. So PEG ratio will be 1.3, 1.4. So as long as the PEG ratio is less than 1.5, you can invest. It is favorable. Here you can see P ratio is 11.58 and PEG ratio you can see is only 0.8 because 14.5% growth is what we are assuming we'll get there. But I'm just showing you the PEG ratio. PEG ratio is 0.8. Less than 1.5 is good. 8 is great. 0.8 is great. So as you can see, P ratio is favorable. PEG is also favorable. What is earnings yield? Inverse of P ratio is this earnings yield. Because if 1 divided by P ratio will get you this percentage. Because if you have a percentage, then you can compare it with something else. So we compare it with 10-year government bond yield. Today, 10-year government bond yield is somewhere around 6.75%. So this company's earning yield is much better than the FD returns, something like that. Cash return is not up to the mark, but it's okay. It's a supporting ratio. Price to sales is also good, like less than long-term averages. Price to book is also less than long-term average. So as you can see, the P ratio is great. Supporting ratios are also great, which indicates the speculative return of this company will be positive. Speculative return. Here you can see positive 6.43% speculative return is expected from Mahanagar Gas. So speculative return is positive, and of course investment return is also positive here. The overall total return expectation is 22.62% in next 10 years. That is the CAGR expectation. But we are only done with the relative valuation so far. So in the relative valuation, what we have tried to understand is whether the speculative return of the company is positive or negative. And we have realized the speculative return here is clearly positive. Now we shift focus from speculative return to investment return. This is where the DCF model will start. Now what I want you to understand is what is the intrinsic value of a stock. What is the intrinsic value of a stock? It is nothing but all the money that the business will generate in its lifetime, discounted it to the present value. That is what it is. All the cash that the business is going to generate is what? The value of the business. Now, pay attention, because, like I said, I want to place more emphasis on the valuation so that I covered all these topics so that I can spend more time on the valuation part. Now, try to understand this. Valuation is simple but tricky, because the formulas and all, they are simple. The tricky part is your assumptions, because whenever you are making assumptions and all the assumptions are regarding future, the probability of you going wrong is very high. You can go wrong, and you can go wrong badly. With wide margin, you can fail. So that is the reason, pay attention and be conservative. Whenever you are trying to value, be conservative. Because of your valuation, if you miss any idea, it's okay. Like, I'm 30 years now. I want to invest in the stock market as long as I'm alive. It can be next 30 years, it can be next 40 years, it can be next 50 years, whatever. As long as I am alive, I want to invest. So I'm okay if I make some conservative assumptions while investing. I miss some opportunity, and that went on to become 5x or 10x. I am okay with that. But I am not okay where I am extremely aggressive. After I am valuing a stock, ended up realizing that I'm aggressive and the stock lost money. That I don't want. Missing opportunity is okay for me. Losing money is not okay for me. Got it? So I'll explain the valuation process. Very simple. What I've said, value is nothing but all the cash that the business is going to generate in its lifetime, discount to its present value. So there are few things that you require. But before going there, just just a simple question so that you understand the perspective. Let's say there is a business. I always say this only. I know most of you already understand this concept, but only to brush up the knowledge, I'm doing this. Let's say there is a nearby business. Okay. Here, let's say this is 1. This is 2. Let's say there is a nearby business. It can be anything. Let's say petrol pump or bakery or whatever you want. There is a nearby business which is for sale. Okay. So these are the numbers. So let's say there is a nearby business which is for sale, and you want to buy it, but you only want to buy it when the investment is favorable to you, right? So this is what the business looks like. If you buy it in next 10 years, every year you will receive 1 lakh rupees in cash. I mean, every year 1 lakh cash is your profit. You will generate 1 lakh rupees in profit, which is your cash flow. Your profit is basically your owner's funds. That is the free cash flow for you. For next 10 years, every year you will get 1 lakh, 1 lakh, 1 lakh. And in the 10th year, you will sell it, which we can call as liquidation value. You are selling it in the 10th year, and you will get 5 lakh rupees for this business if you sell it. Now, think about this. Assume it is a real life scenario. Don't assume it as if I am throwing some numbers here. You are merely doing it for the sake of fun. Don't treat it like that. Assume it is a real life situation. You really looking at a business. Okay, you will get 1 lakh rupees each every year. You can sell it after 10 years and you can get 5 lakh rupees. What do you think should be your price, buying price? At what price you will buy this? Now, you might be mentioning more any prices you want. It can be 4 lakhs, it can be 6 lakhs, it can be 9 lakhs, it can be 25 lakhs, it can be 1 crore. You can mention whatever price you want, but the point is there is a value for this business. Your price can be anything. You can say I'll pay 10,000 rupees, give me the business. Your price can be anything. But what is the value of this business? So before deciding or before looking at your price, let's try to understand what is the value of this business. Like I already said, the value of the business is all the cash that the business is going to generate in its lifetime. Now you see, sum of all these numbers is 15 lakhs. 1 lakh, 1 lakh every year. Liquidation value is 5 lakhs. You add up 15 lakhs. So the value of the business is 15 lakhs. Now at what price you will pay? For example, someone might have mentioned 3 lakhs. Okay, fair enough. Someone might have mentioned 5 lakhs. Fair enough. 7 lakhs. Okay, you are still 50% discount you have. 9 lakhs. Okay. 12 lakhs. Okay, you don't want a very big upside. You are okay. You just had like 20% margin of safety. You are okay with that. Fine. 15 lakhs. If your price is 15 lakhs, then my question is, what is the point of buying the business then? Because you are paying fair value. I mean, there is no point in buying that business at fair value. You pay 25 lakhs. That is outright stupidity, right? Value itself is 15. You are paying 25 lakhs. So, this is the USP. If you as an investor can understand the intrinsic value of a stock, you will have huge advantage over the rest of the market, because the market knows Mahanagar share price is 1240 rupees. That's what the market knows. But market doesn't know the intrinsic value. You can go and search in Google, like what is the intrinsic value of Mahanagar gas. You can go and do a Google search. You may not find it. Or even if you find something, how can you trust it? Trust issues, because when you are investing your money, how will you trust? So you need a process for the valuation which you can trust, which should work. I am investing for 12 years, and if you ask me like why I'm so confident or why I have such high conviction on my investment ideas, is because of my valuation process. I trust my valuation. I mean, I trust my valuation more than anything, because I'm doing it for quite some years now, and I saw the results, and I guess you also saw the results. So that's what gives the conviction. So you need a process for that. Now let's look into the process of valuing a stock. What is required? Psychologically or methodology wise also, what is required? There is one catch here. I said the value of a business is 15 lakhs, but all the cash that the business will generate in its lifetime discounted to its present value. Here we are not doing any discounting, because to simplify it. For example, 1 lakh that you will receive today is not equal to 1 lakh that you will receive after 5 years or 10 years, because there is risk involved, there is opportunity cost involved. So we have to discount future 1 lakh. We have to convert that into present value. Let's say I'm going to receive 7 lakhs after 7 years. It is not 7 lakhs today, because I am going to receive it after 7 years. What is 7 lakhs worth that I am going to receive after 7 years worth today, which will be lower than 7 lakhs, maybe 3 lakhs or 4 lakhs. we have to do that adjusting part. We have to convert that. That I have not done here for the simplicity purpose. Now let's look at the valuation. Discounted cash flow model. We want cash flows for the rest of the business. In my examples, I gave you 10 years and I said liquidation value. But if it's a real business, everything I have to compute. You know, first thing that I need is the free cash flows. Because without the free cash flows, I cannot value a stock. If I want future cash flows, first I need the current cash flow. And this current cash flow is an accounting number. I'm not actually assuming anything, or I'm not creating it or inventing it. It's an accounting number. I can go and check in the cash flow statement. I'll find it. Got it? I can just find it in the cash flow statement. So this, you can see 382 crores. Where did I get that from? From the cash flow statement only. Now the current year free cash flow is 707 crores. But by default, the Excel sheet will take the last 3 years average. Why 3 years average? Generally, what happens is free cash flows are more fluctuating because of the capex cycle. For example, a company spent a lot of money this year on capex. Maybe next 2-3 years they don't spend anything because the investment is already done. So next 2-3 years the cash flows will be very high, but the current year the cash flow will be very low. So you cannot take any 1 year cash flow at face value because of the capex. There will be fluctuations. So that is the reason, to average out those cycles, by default the Excel sheet will take 3 years average. But let me be very honest with you. This is where you have to, you need to put whatever thought you can. Basically, there is no hard rule for this. What I do personally is I make sure whether that number is realistic or not. Only that much I think. It's not like 1 plus 1 is equal to 2. It doesn't work. There is a number, and what I look at is whether that number is realistic or not. Here it is 382. Now, for example, if I take the current year number as 707, I have a small issue with that. When I ask myself whether that number is it realistic, I am not able to convince myself because that number, this company never generated in the past. It is only in the current year there is a one big 700 crores as a number. And if I take that, I personally feel I'm being very aggressive. Like I already said, I am okay missing opportunity. I am not okay losing money. I don't want to lose money. Missing opportunity, fine. Losing opportunity, I am not okay with it. So 707, I'll not put it because I mean, my personality will not let me to put 707, whatever it is. In fact, even someone from future comes into present and says, no, you put it as 707 because I am coming from the future. I already know it. Even then, I will not be able to put it. So that's who I am basically. I'm very conservative when I am putting this number. So 707, I'm not okay with it. Chalo. What about 234 or 207 then? Let's say 207. Now I'm punishing this company for no fault of it. You can see 207 is the lowest. And even if I take the last 10 years average also, that number is somewhere around 350. So if I am putting it, I mean, if I am keeping it at 207, isn't it an injustice for this company? Like I'm just punishing it. Every year it generated more than 207 only. So, I mean, unnecessarily, I'm being extra cautious, extra conservative, which is also not required. If I do that, I'll miss every opportunity. So I need to find a balance, right? So that balance I have taken as 3 year average. So 382. So what I have realized is the last 10-year average is 350. 382, is it realistic? Okay, here it generated. Here also it generated. Here also it generated. Here also it generated. Here it was close. So as you can see, most of the years 382 is manageable by this company. So I am okay. 382 is fine for me. I need this number because this will be my base. I want to estimate future cash flows. If I want to estimate the future cash flows, then I need a base cash flow. So this will be my base, which will help me in calculating the future cash flows. 382, done. And now, I hope you got it. This is not science. Initial cash flow is not a science, but it's an art. You will master it with experience. That is what I can say. Because it is not science, it is not 1 plus 1 is equal to 2. I get many questions time and again saying like, this company cash flow is this, that company cash flow is this, it is negative, it is high, it is very low. You have to adjust it if it is required. With most of the companies, it may not be required. For example, look at Mahanagar. I didn't adjust anything. I just kept it at 382 because I felt 382 is reasonable. With some companies, I may adjust. How will I adjust? I will go through annual report. I'll go through conference call transcripts. I'll do whatever I can. I'll find some piece of information after I go through all those documents somewhere. Some unusual place also I'll find some information which will give me this clarity because I have this question in my mind. What should be my initial cash flow? Like I am always, thinking deeply about that. If I go and search, I'll find it somewhere in the documents, in the annual report, in the investor presentation, somewhere I'll find it. They'll not mention this number. They'll give me an idea of we are expecting this capex. So they gave me a capex projection. With that, I can get my initial cash flow number. So whatever it is, it's an art. It is not a science. With experience, you'll master it. Initial cash flow is done. So my base number is done. Now I want the next 10 years of cash flows here. How will I do that? Pretty simple. What you'll do is once you got this base cash flow, you put a growth rate to it. You give it a growth rate. So with that growth rate, you will estimate the next 10 years of cash flows. But again, the question is very simple. 382, I'll give a growth rate of whatever I want. So next 10 years of cash flows, as you can see here, next 10 years of free cash flows will be computed. I can give 20, I can give 50, I can give 200 also as growth rate. But have to estimate that growth rate two ways. Backward looking is also you can use, forward looking also you can use. What is backward looking? Pretty simple. You can go to the past. Go into the past, look at the past growth rates. Here you can see 27, 18, 18, 17.5 is the last 10 years net profit growth. You can simply go and put that 17.5. You can just put 17.5, the job is done. But I never do that. I never take past growth rates into this valuation. I'll never bring them because I am more interested in the future looking growth rate. Have to do that. Future looking growth rate is nothing but you need to understand how growth happens in a company. Growth is nothing but how much the company is reinvesting. And on that reinvestment, how much the company is generating, how much profitability the company is generating. So formula is 1 minus dividend payout ratio into return on equity. That is the formula. 1 minus dividend payout ratio into return on equity will give you the expected growth rate in the future. Now you can see here there is return on equity. There is 1 minus dividend payout ratio. You got a growth rate. Now since they are in yellow, what yellow indicates? Again, you can adjust if you want. You can adjust Don't change anything. Only in yellow cells you can adjust. Now return on equity is 25 here. Again, return on equity can also change dramatically over the years. That number is current year's number. It can be the highest, it can be the lowest. Have to know that. You go and check the profitability, this thing, you will realize 25 is actually somewhere around close to highest. You can see that. The average is somewhere around 21. Long-term average is somewhere around 21. Now it's again, as an individual, it's our decision. So am I okay with 21.3 or am I okay with 25? If I keep 25, because by default, the Excel sheet will take this, as you can see. Now again, you already know that I am very conservative. So personally, I will change it towards 10-year average. But chalo, now even if I don't change also, the valuation doesn't change much. So for the purpose of not adjusting, I am not adjusting. But if at all I want to adjust, I may adjust it to somewhere to something like 1 second, to something like 21 and all. But again, it's up to you. You want to adjust or you don't want to adjust. Again, it's personal decision. Like I said, 25 is okay. Next is 1 minus DPR. So here you can see, you can take an average, you can take the current number, or you can, if you are reading something and you got some information from there, you can take that. So like I said, it's not just science, like it's an art also. So most of the decisions are made by you. Assumption related, it's not written somewhere in a book. It's not thrown to you from the management or anything like that. You make the decision. Now, why I am keeping this 25% return on equity, there is a reason for that. What I'm actually assuming, I am assuming that the margins will improve from here. As you can see here, the 18% margins, those margins will improve. When margins improve, the return on equity should also improve. So what I am assuming is there can be improvement in the margins. So I don't want to punish the company by reducing its growth rate. I am assuming a high growth rate. So that is the reason I am still keeping it as 25. So for me, it is not a number. Nothing is a number for me. For you, it might be a number. For me, it's an expectation. For me, behind every number, I have some expectation. So 25, because I think the margins will improve and that return on equity can be maintained. Next is dividend payout ratio. Again, like I said, the company is reinvesting a lot in these years. So, which is reflected in the recent growth also. More than 10 years CAGR, 3 year CAGR is very high. Sales growth is also very high. So, company is reinvesting aggressively. So, in the past, it paid dividends, but right now, I don't think they are paying that much of a dividend. They are trying to grow. So 19.3, I'm not going to disturb that. So, which is in line with my expectation. So 25, it will generate 77, it will reinvest. So 19%. For next 5 years, it won't change. It won't change. But no company can generate high growth forever. Eventually, the company will slow down. Any company will slow down. Mahanagar Gas will also slow down. So from the 6th year to 10th year, I'm slowly moving the growth rates towards 3.7% or 3.75. Why? Because that is my terminal growth rate. Up to 10 years, 1 minus DPR into return on equity, I am using that for 10 years. What about 11th year to eternity? Technically speaking, at least theoretically, a business can live forever. 500 years, 5,000 years also a business can exist. Theoretically, at least. So will I sit down and estimate cash flows for next 2000 years or what? That doesn't work. So from 11th year to eternity, I just capture it in a formula. I'm not going to cover the formula because it's not going to help you anyway. Excel sheet is what we are using anyway. So you are not computing it manually. We have a formula. In that formula, we just capture everything. But growth rate is required for that. A growth rate, you should put 11th year to eternity. What will be the growth rate? There is again no rule for it. Exact rule is not applied, but the only logic that you need to apply is that number should not be bigger than the economic growth rate. Because the logic is, if you are inputting a number which is bigger than the economic growth rate, then that company itself will become the economy. Because 11th year to eternity, that can be anything. So you compounded at a very high rate will become the economy eventually. So we have to be careful. So my suggestion is, don't put the terminal growth rate more than 4%. Whenever we are valuing a stock, the terminal growth rate will 11th year to eternity, those cash flows less than 4% should be our estimated growth. And I take 3.75. So in every Excel, you will find it as 3.75 by default. So what I am assuming is eventually the return on equity will move towards 15% and the reinvestment will move towards only 25%. Most of the companies will start paying a lot of money as dividends. That is what I am assuming. 3.75. So that's what reflected here. So all these numbers you see here, these are the growth rates applied. For the first 5 years, 19.3% growth is applied. From 6th year to 10th year, slowly moving towards the terminal growth rate. But there is a catch. These are free cash flows. We are taking the base cash flow, which is 382. We are applying a growth rate and we are able to calculate all these 10-year free cash flows. But again, 775 crores after 4 years is not equal to 775 today. Like I already said, future number you need to convert it into current value. Have to convert it. For that we need a discount rate. Discount rate is very simple. Let's say you have 100 rupees. I said I'll give you 10% interest on that 100 for 1 year. 100 into 10% return after 1 year will become 110 rupees. Let's say I paid 10% interest again also. In the second year, it will become 121 rupees. So you have 100 rupees at 10% interest. After 1 year, it will become 110. After 2 years, it will become 121 at 10% interest. So you can see this is interest rate. This is interest rate, which is going forward. Discount rate is nothing but inverse of interest rate. It is coming backward. For example, 121 rupees that you will receive after 2 years, discounted at 10% is worth 100 rupees today. So 121 rupees 2 years after if you receive, its value is only 100 rupees today. So discount rate is coming backward. Interest rate is going forward. Now what discount rate we should use? What is the logic behind using the interest rate? So you can see the discount rate here is 12%. Why it is 12%? What is the logic? Very simple. Whenever we are looking at the discount rate, this is the logic. You can see here, these things drive the discount rate of the company. First is, what is the size of the company? Large cap companies are low risky compared with small cap or micro cap companies, right? Large caps are less risky. Micro caps are high risky. If you look at Mahanagar, it is a mid cap company. So mid cap company risk is, I would say, moderate. Financial health. this company's financial health is strong. Earnings growth, there is some cyclicality, definitely. So it's not consistent. I would say moderate cyclicality is what I would say. Like wide moat, yes, this company has got wide moat. Management, high quality management. Complexity. What kind of, do you think the business is very complex? I don't think so. They operate, it's a gas distribution company, CNG, LNG, a PNG, and they operate in Mumbai and Raigad. So they have filling stations. I mean, it's a simple business. No complexity. They don't have 20 different business operations. So complexity is low. Now, overall, if I have to give it a score, it's not a high risky business. In fact, looking at the moat, looking at the management, it seems like a low risky business for me. And in fact, the 2 minute test that we do, I'll again show you the 2 minute test and all, but in the 2 minute test, whatever we do about this stock, if the company pass our 2 minute test, only then we'll invest, right? For example, go and check the 2 minute test. So whatever balance sheet, whatever this thing we have done, for example, here you can see this is the financial health analysis. This company can meet its long-term as well as short-term obligations. Now, this is where we try to understand, okay, this company is making money. It is consistently making money, growing from last year. And this is where we realize that it's a high growth company. And of course, this is where we realize that, okay, cash flows are positive, cash is coming in. So, and income statement and cash flow statement narrating the same story. That's where we realized. And this is where we have realized, okay, this company is generating high profitability and high quantity profitability. You can see free cash flow to sales. So this company passed our 2 minute test. If the company doesn't pass our 2 minute test, then we don't do all the valuation and all. Not worth it. If the company fails, then we are done. Only if the company pass our 2 minute test, we do all that analysis, or else we are not interested. Got it? Don't try to value every stock, because you will not be able to have any kind of conviction in a business where it is making loss and all. How you will pick an initial cash flow? Whatever you pick, you will not have any confidence. What discount rate you will pick? Because it's a high risky company. So what discount rate? Discount rate will be very high. So with the companies, with the kind of companies that we are investing in, I want you to put it at 12% because the median discount rate in India is somewhere around 12. So with a company that pass our 2 minute test, or the company kind of companies that we are looking at, around 12 is okay. So I think we are done with all the assumptions here. First is the initial cash flow. That is an accounting number. You can do whatever adjustments you want, but make sure whatever number you are putting, it should be realistic number. That is the only condition. You take 1 year number, current year number, 2 year average, 3 year average, 5 year average, 10 year average, or you take 2019 number as free, whatever you want, you take, but make sure it is realistic. Then comes the growth rate. Don't directly put the growth rate. You can change the return on equity if you want, you can change the reinvestment rate if you want, or else you can directly take whatever the Excel is providing. It's up to you. Whatever analysis you have done, based on that, the numbers will follow. Because behind every number, there is an analysis, there is an expectation. Then comes the terminal growth rate. Don't put anything here, just let it be 3.75. Don't change it. So don't adjust terminal growth rate. Keep it 3.75 for every stock. Next is discount rate, which is 12%. Don't change it. Why it is 12%? Because uh, discount rate is nothing but operating opportunity cost plus risk involved. In India, what is the operating opportunity cost? Around 6.75, because the 10-year government bond yield is considered as the opportunity cost. So that is somewhere around 7%. And the equity risk premium in India is somewhere around 5%. So if you add that up, somewhere around 12% will be our discount rate in India. So you keep it at 12%, don't even change it. So if you are valuing a stock, if at all you want to adjust, there are only four important numbers that we are looking at. initial cash flow, 1 to 10 years growth rate, terminal growth rate, and discount rate. Only four assumptions. Four assumptions. In this four, I don't want you to change two. Discount rate don't change, terminal growth rate don't change. So you can adjust only two things. Growth rate you want to change, you can. Initial cash flow you want, you can. Or else you don't. As simple as that. And with Mahanagar Gas, I am not changing anything. I have not done any adjustment. Based on that, the value per share is 1108 rupees. Share price is 1240. So close to fair valued. You know 90% of, so the current share price is 10% premium to its intrinsic value. So mostly closer to fair value. But I don't take 1 year, DCF valuation that seriously, one kind of valuation seriously. In our process, what we do is we look at multiple valuation frameworks. Because, like I said, this is all future estimations I am doing. And I can go wrong also. Do you think I am God or what? No one knows what future holds. Anything can happen tomorrow. I am just making assumptions. So my assumptions can also go wrong. So what should I do? So I will depend upon various valuation metrics. Only then I come to a conclusion. So DCF almost fair value. What else I do is a aggressive versus conservative valuation. Also I'll do that, which is what I call as the best case and the worst case valuation. Concept is pretty much the same. I don't change anything. The only thing I change is here I am going to use aggressive valuations, aggressive growth rates. And here I am going to use conservative growth rates. One side I want the maximum number of, what can be the maximum value? Give me that. What can be the minimum value? Give me that. So valuation is never a precise number. It's always a range. Valuation is never a number, it's a range. Between this range, this can be maximum, this can be minimum. That's what you can do. So Dandu or best case, worst case is going to give me that range. And you can see 1400 is the maximum. 900 is the minimum. So the actual value of this company is somewhere between 900 to 1400. And of course, this number is in between. This number is somewhere in between. Now we got a precise number, we got a range, and we have the total returns valuation also here, which is nothing but I am assuming what should be the 10-year growth rate. What can be the next 10-year CAGR? So based on my assumption, 14.5% will be the next 10 years growth rate for this company. The same concept, instead of cash flows, I am going to apply it to the earnings of the company. That is the net profits of the business. You can see in 2024, 1,289 crores is the net profits of the business. Same, I am going to apply this growth rate and I am going to assume the next 10 years of net profits. 2025, 26, 27, 28, and in 2034, what will be the net profit of the company? This 4095 will be the net profits of Mahanagar Gas in the 10th year from here, 2034. How did we get that? Because 14.5% growth is applied. So that will be in the 10th year net profit. We apply a multiple for that. And exit multiple we call it. We take that, we give it an exit multiple. That exit multiple, I always keep it at 20. I will never go beyond 20. Because, we have to be conservative again. See, if I am not going beyond 20, actually helping me, I always have surprise returns instead of shock, losses. If it can trade at 25p, 30, 40p, it's okay. That's a bonus for us. We generate good money if that is possible. But you cannot show me some exception and call it a rule. So my rule is 20. Exit multiple will be 20. So 4,900 into 20 is 81,900. This will be the market cap of this company in 10th year from here. Mahanagar Gas market cap will be 81,000 10 years from now. But like I already said, 81,000 10 years from now is not equal to 81,000 today. What I have to do is discount that 81,000 into present value. What will be its market cap? So at 12% discount, discounted market cap in the current value is 27,000 crores. If the earnings grow at 14.5%, 10th year, 4,000 crores will be its net profits. You apply exit multiple if the stock is trading at 20 P. 81,000 crores will be its market cap. In today's value, it will be 26,000 crores, 27,000 crores. But it is currently trading at only 12,000 crores. So based on total returns, also it is undervalued. So we are using multiple valuation frameworks here, earnings based, cash flow based. Now you see, we have lowest at 900, 892, highest at 2,700. Here we have 1,400, we have 1,500. So out of all these numbers, what number should I take? Obviously, I'm confused, right? I have so many numbers here. Generally, what I do is, instead of relying on one single number, what I personally do is, I take a weighted average of all these numbers. Instead of trusting one number, that is law of large numbers, I am going to rely on multiple numbers, law of large numbers. Even if I do any error in one valuation, that law of large numbers is going to help me. So I take a 20% weightage. 5 numbers we have got here. 20% weightage to each of these numbers. So I get 1,537 as my intrinsic value, which is my weighted average intrinsic value. I am not taking any single number. I am not trusting any single number here. I am taking weighted average intrinsic value. Got it? So that is that's the intrinsic value for me. These are all, multiple numbers that we have got, multiple valuations, but this is what my intrinsic value would be if you ask me. Based on that, I am going to make the buying decision. So have to make, of course, before getting into buying decision, I want to show you something. So I'll show that and then we'll break for lunch. Then we'll get back. After post lunch, I'll cover when to buy, how to decide buying and all. That I'll cover post lunch. So this is what we are done so far with Mahanagar Gas valuation. But the point is, all these numbers, most of these numbers are automated numbers. Everything is automated. You are making one or two adjustments, but with Mahanagar, you just export, this will be the value. No adjustment, nothing. But you know what? Once upon a time, I used to value the same business using such manual, Excel files. So the numbers that you see here, these are, of course, there are some formulas and all, but the inputs are all manually made. So here you can see what we tried to do here so far is we directly used cash flows and tried to value the business. But this is what happens behind. This is why I said, like, it's very important for you to understand the valuation. I mean, you should go through balance sheet, income statement, cash flow statement. This is what we are looking at. Now, first, let me cover the reverse DCF valuation here. What is the reverse DCF valuation? Before I invest in a stock, I want to understand what the market is expecting. The share price that you see here, 1,240 rupees, that is an expectation. Market has an expectation. That is the reason it is worth 1,240 rupees. What expectations I want to know as an investor? So I do reverse DCF valuation to understand the market expectations. So here you can see current revenue is 6,626 crores. That is the current revenues. Current margins are 1846. This operating income, this is the current tax, this is the current after tax operating income. Again, these are all accounting numbers, current year accounting numbers. These are all assumptions. Now, the first assumption that I need to make is the revenue growth of the business. Then I have to make EBIT margins, then tax rate, then so on and so forth. But before we go there, I want to show you something. 1 second. Let's try to understand Mahanagar Gas little deeply. Like I said, everything will get every information used in the valuation. I have mentioned that. So now we are going to use that here. So first things first. So if you look at Mahanagar Gas, the operating margins of Mahanagar Gas, as you can see here, current margins are 18.46. I hope you can see the screen. Can you see the screen? Please raise your hands. Can you see the screen? Okay. Current margins are 18.46. Long-term average is 25. So margins have dropped significantly. Before valuing a stock, I want to know like what is the reason? Why the margins are dropping? Now, there are many reasons for the drop in the margins, but the point is first is a reduction in APM allocation. This is nothing but, like I already said, the government gives these companies an allocation, and that allocation happens at a lower price. So, for example, just as an example, Mahanagar Gas requires 10 liters of, let's say CNG, 10 liters of CNG. In that 10, almost 9 liters would be provided by the government itself at a lower rate. Only the remaining 1 liter they'll go or get it from a spot market, or they'll import it. Majority the government will provide at a very cheaper rate. Recently what happened is the government reduced that allocation. Let's say from 9 liters, government is giving only 6 liters. Now, before they have to buy only 1 liter from in the spot market at higher prices. Now they have to buy 4 liters in the spot market at a higher price. So margins are dropping because of that. Got it? A administered pricing mechanism, whatever the allocation, that allocation is reduced, which in turn reduce their margins. But in Jan 2025, temporary so okay, the allocation was reinstated in January 2025. So as you can see last month, so the allocation was increased, which is a good news. Increased procurement of market gas, which is again the reason is allocation. Since the government is not allocating enough, they are buying it from the open market. So open market, the prices are much higher. So again, which is impacting the margins. Regulatory challenges in gas allocation again revolves around gas allocation, as you can see. So next is increased cost and capex. They spent 800 something crores, 700 crores previous year. So they are doing a lot of capex. They are expanding. So whenever there is a big capex, some operating expenses go up, one-time operating expenses, which will hit the P&L. They are mostly one-time expenses. So that is also included in the current P&L. Lower realization in certain segments. So obviously gas is a price sensitive market. For Mahanagar Gas, the cost is going up. Why? Because they are buying gas from open market and all. Government is not allocating. This company is not able to pass on all the increase, whatever cost that they incurred. This company is not able to pass on to the customers because CNG, LNG, LPG and all, that is price sensitive market. So that is the reason they are not, and because of that, they are not able to pass on the price. They are taking the hit, which is seen in the margins. So that is the reason margins are dropped. But I have mentioned five reasons, but there is only one reason. If you have to keep it simple, government reduced that APM allocation. Because of that, the issue happened. But in 2025 Jan, there was some reinstated. So going forward, if they allocate more, again, this problem is temporary. That is what I wanted to know, whether it is cyclical or structural. Margins are at 18, long-term margins are at 25. From 18, if it goes to 25, great. But that will only happen if the problem is cyclical. If it is structural, from 18, it will go to 15, 14, 12, and the company will be gone case eventually. Right? That is the question I want to know, whether it is cyclical or structural. I think more than structural, I think it's cyclical. The reason is pretty simple. Temporary reduction in APM allocation. So as you can see, in October and November, government reduced the allocation and partially reinstated within January. As you can see, this allocation keeps on changing. So there is a cyclical element to it. This is a temporary adjustment allocation than a long-term policy shift. And next is, you can see, government supports this CGD, that is CNG and PNG sectors. Government provide a lot of support because uh, recently High Court in Mumbai also supported phasing out of petrol and diesel. So Maharashtra or Mumbai especially wants petrol and diesel vehicles out of the system, which they want to replace it with CNGs and EVs. CNG and electric vehicles is what the government is also wants to replace it with. So definitely, if that is what government is expecting, then obviously the allocation should be higher going forward. So it seems cyclical. Eventually, the government will provide the allocation. Global gas price volatility, of course, crude oil and all, the prices fluctuate. Based on that, the prices in the local market also fluctuate. So crude itself is cyclical. So margins fluctuate. What is the structural risk here? I found one structural risk, that is shift towards market based pricing. So Kirit Parikh committee recommendation introduced a price ceiling of $6.5. Uh, but this policy allows gradual increases, meaning APM gas may become costlier over time, squeezing margins. Like I said, buying the purchasing price of gas matters for this company or any company in this industry, Mahanagar Gas or Indraprastha Gas, any gas. Eventually, if the allocation is reduced or the price, I mentioned the moat. In the moat part, I mentioned regulated license is a moat. Getting gas at a cheaper cost is also a moat. But that moat is slightly, in risk, because eventually if the company is not getting enough allocation, then obviously the margins will be squeezed. If government is not allocating, then what Mahanar Gas has to do? They have to go and buy it in the open market. Open market price is little higher. Here they are getting subsidies. There they won't get any subsidies. So margins will be squeezed. Growing competition also. Recently, this company lost marketing exclusivity in GA1, GA2. GA1 is Mumbai, GA2 is their Raigad district, which is again closer to Mumbai. So now new players could enter. Their pricing power can be challenged. There again, there is some moat which is being disturbed here. Previously, they had regulatory license. Now their regulatory license moat is being disturbed, but again, they have network exclusivity. Uh, of course, in intensification and competition can definitely uh, hamper their growth. It can hamper their margins also. But again, we'll see. Again, this is what I feel right now. I feel it is more of a structural. I am still thinking it is cyclical. If I kind of feel this shift is happening in a structural way, then we'll get out of the stock. So as of now, I think it is cyclical, but if it is structural, we'll get out. Again, fuel transition risk. While CNG is government backed, EV adoption is accelerating. So long term favorability is more towards the EV side. But again, what if EVs doesn't grow as the government expected? Maybe market can shift towards CNG and such companies. We are not sure. But I think personally this is a cyclical reason. Crude is cyclical, allocation is cyclical, the pricing and all, that is also cyclical. So as of today, at least next 3 to 5 years, I am not seeing any structural shift here. Maybe after 5 years, if there is any structural shift, we will see. Next is revenue growth. Now, what can be the revenue growth for this company? So as you can see, EV is taking some chunk of the market going forward. So I think the projected sales for this company would be slowing down, which I have mentioned in my valuation. Also, the growth rates drop here. Also, starting currently, the last 10-year sales CAGR is somewhere around 13%. Now, from 13, I am slowly moving it towards 7-8% by 2034. But overall, average growth rate, if you look at average growth rate, it is estimated to be around 9.9, which is around 10%. From 13%, 13% is generated in last 10 years. I am assuming next 10 years sales growth would be 10%, which is slightly lower than the last 10 years. Now, what can be the reasons for the slowdown? One is market will get saturated. Obviously, that happens with every business. Increased competition. Like I said, this company is losing that exclusivity. Now, new players can also start. Regulatory changes impacting pricing and demand. Of course, new players entering will affect the pricing, and new players will bring in a lot of supply also, which will impact the demand. Shift in consumer preference. Like I said, EV transition, industrial gas. This EV transition, EV will take some market share. That's the reason the growth is dropping. And their next 10 years growth can be higher than 10% also if government mandates more CNG adoption, as seen in the recent Mumbai High Court ruling that petrol, petrol and diesel vehicles slowly going out of the system, and the government saying only CNG or EV is allowed. Then you see like how big the market can grow. Then the growth rate can be higher. Uh, if the company is expanding into new areas, new geographies, or new product segment, like for example, biogas, EV partnerships also, if they are doing so, EV stations, if they are able to build, so then that can be phase two growth of the company. But again, I am making all these assumptions. So we'll see what happens in future. I am only assuming a 10% growth. Now, whatever I have mentioned so far, you will see in the valuation. So this is my story for the business. This is my assumption. This anything can happen, good or bad. I have both assumptions. So, but first, what market is assuming? Let me show you. 9.54% growth is what I am estimating. So I am just making value per share and share price equal, and I am just inputting the variables so that you will know what market is expecting. 9.54, which is 10-year CAGR. 9.54 is only for the first 5 years. Later on, it is slowly moving towards 4%. So overall 10-year CAGR is assumed at 7.86%. So market is expecting 7.86% in next 10 years. That is sales growth. What about the margins? See, we are expecting margins will grow, but the market is expecting that margins will fall. From 18.46, market is expecting the margins will fall towards 16.5%. And growth in the free cash flows, you can see this growth in free cash flows. Market is expecting only 8.24% growth in free cash flows. So I think market is being extremely conservative with Mahanagar Gas. Market feels this business is gone case. They will not get any growth. The new players that entered will eat all the growth, will eat all the margins, is what market is expecting. But what I am expecting is, like I already mentioned, this is what I'm expecting. If I keep 12% here, overall 10-year growth rate we should look at. Overall 10-year growth rate is 9.56, which is close to 10. I'm expecting 10% growth in the next 10 years. 9.56 is closer. Let me keep it there. 18.46 is current margins. But what I'm expecting, this is all temporary. This is a cyclical thing happening. The margins will revert back. What is the long term margins? 25% is the long term average. But I think personally, EV taking some market share, new players also entered. So the government company lost some exclusivity. So I think 25% this company may not reach, but I think somewhere around 22% this company can reach. Not 25, not previous margins, but 22 this company can generate in next 10 years as a long term margin. So I'm keeping it at 22%. Then 25% will be the tax rate that I'm not changing. Sales to capital ratio, you can see here, current is 1.7, but average is 1.8. So I would like to give it a long term average of 1.8. And this is my expected return on invested capital. Current return on invested capital is around 23-24%, and I am saying that more or less the same kind of return the company will generate in future also. 12% is cost of capital. Terminal growth rate is like 4%. So more or less, this is what I am expecting as value. 1,832 rupees. Margin of safety is somewhere around 32%. But again, let me tell you, I am not inputting numbers for the sake of inputting numbers. Behind every number, there is a story behind it. You can see market was expecting some 8%, 9% growth in free cash flows, but I am expecting the free cash flows will grow at close to 15%. 14.75 to 15% the free cash flows will grow is what I assume. So that is what the valuation is all about. 1832 is the value per share. 1240 is the current share price. So I think there is enough margin of safety. So that is the reason this particular stock is in the buying zone also. So revenue growth, you can see we have a reason for that revenue growth. Operating margins, we have a reason for, we think it is cyclical. It can revert back. We have a reason for that. So every number, cost of capital, again, it's a moderately risky business. So 12% is more than enough. Got it? So that is the value of Mahanagar Gas. Now I think it's 12:10. So what we'll do is at 12:30 we'll break for lunch and then we'll get back and I'll cover the remaining, like when to buy, when to sell, portfolio management, and so on and so forth. But chalo, in case we have some 10-15 minutes, what I'll do is I'll take some questions. You have some questions here. VS Reddy is asking me, we pick undervalued stocks which might be down a little even after we buy, unlike others. Now the question is Valiant, Radian, I am not bothering about losses, but those are correcting 50-60% against our principal. Please explain. See, the downside is never in our control. For example, you can see the valuation of Mahanagar Gas. The current price is 1240. Value is 1800. From 1240, if it goes to 400, I mean, how is it in my control? Price is never in our control. What is our advantage? Understanding the valuation is our advantage. Predicting the price is not in our control. A stock which is undervalued can become extremely undervalued. So, I mean, I don't even have an answer for that. What correcting 50-60% against our principle? What against our principle? Like, our principle is not having a stop loss or anything like that. Our principle is very simple. You estimate the value, you estimate a price. You estimate a value, then at margin of safety you buy. You buy at a margin of safety. After you buy also the stock might go down. For example, I bought TGV stock at 22 initially. From 22 it went to 16. From 16 it went to 12. From 12 it went to 11. That is also 50% drop. I was averaging down all the while. Repco Home Finance. My first starting point of Repco Home with small quantity I bought at 350. Exactly 15 days before COVID crash, I bought Repco Home Finance at 4p, 4 times P. From 350 it came to 190 also. 350 to 90, leave this 50-60%. You tell me what will be the crash 350 to 90. I bought at 90 also. And right now the share price, but I bought a little quantity at 350, major chunk of it I bought at 90 only, but it happens. So that is not in our control. Price is not in our control. So as per Mr. S. Naren, now maximum stocks above 43 PE overvaluation, but recommended stocks are below 43 PE, even below 20 PE. Still, they are also correcting heavily, please. Every stock will correct because the overall market is correcting. The entire market is falling. Uh, Everyone is selling. So, sellers outnumbers buyers in this kind of a situation. So, people who are holding our stock are also selling. For example, let's say Mahanagar Gas. The entire market is falling. We are buying, we recently bought, we are value investors, we bought it for long term. Not everyone is value investor, not everyone has bought for long term. Some random fellow bought, let's say, put 5 lakhs into Mahanagar Gas for whatever reason. Suddenly the market is falling, he'll sell it off. And more than 90% of investors out there do everything randomly. So it doesn't matter whether you buy stock at 43 PE or 4 PE. People will buy in panic. People will buy in greed, sell in panic. So how many, let's say Mahanagar Gas, how many undervalued, how many value investors you think would be holding this Mahanagar Gas? Go and check the shareholding. There might be 1 lakh, 2 lakh shareholders. Out of this 1 lakh, 2 lakh shareholders, how many of them are value investors? Maybe 100, 500, 1,000, very few. Remaining all are momentum fellows. So they buy, they sell whenever they want. So correction will happen. That is the reason many times I mentioned, like, you slowly book your profits, at least 50% be in cash. That is the reason I said. Because when correction happens, every stock falls. Every stock. Good, bad, there is no rule for that. Because people are scared. So they want to exit at whatever price they are getting. Is it advisable to average down if our recommended stock corrects 15% of lump sum holding 10 to 15 lakhs in cash, or even no, I would say like wait for some time. Like, I'll cover that going forward. I'll cover that. I'll end the session with that. But it's better you hold the cash than averaging down, because okay, I'll cover that anyway in the next part of the session. That is in the by afternoon I'll cover that. So you will get a clarity on that. Kiran, market is falling every day. Can you share thoughts on current market condition and what would we do in this situation? Please make a short video. Share your thoughts frequently going forward so that see, I think I have already made enough. I mean, presentations like weekly mentorings and all based on that. See, market is falling. Market has to fall because it went to 130 market cap to GDP ratio, which is overvalued. So I always said that market is overvalued, it should correct, and it is correcting right now. And I think it will correct even more from here. That is possible. That is the reason I said this is the kind of market where we should hold 50% in cash, 50% in portfolio. I think for the last couple of months, I think I'm saying that it's better you have some cash, you have some cash. Having cash is definitely an advantage here. If you don't have cash, then what you need is like pain bearing capacity. You hold the portfolio. I am not recommending sell anyway. If you have cash, you can utilize that eventually, not today, but eventually. But if you are fully invested, then it's fine. You should hold it. Anyway, it's a long-term portfolio. So anyway, I'm going to do weekly mentoring sessions also. So there also you will get to know my this thing, but I am not going to change my opinions every week. My opinion is pretty simple. This is an overvalued market. Expected returns in at least next 6 months or 1 year is not that great. But whoever has got some cash put aside, whenever the lucrative opportunities arrive, then they can utilize this. So that is what I would say. What are your takeaways from budget? So first things first, 12.75 lakhs tax free is definitely good. So appreciated, but nothing on STCG or LTCG. So, but it's okay. I'm something is better than nothing, right? So I'm happy with at least 12.75 lakhs. Now it is tax free. Except for that, what else we have on budget? Like I already said, like there won't be much. Uh, I generally never follow budget because whatever they mention, it will never materialize. No, no. I mean, last budget, no one remembers today. This budget, no one will remember next year. So, actual impact will be very lower. But this 12.75 is directly impacting everyone, which is appreciated. So, yeah, I'm positive on budget. But something on LTCG or STCG would help us directly even more. Premlata is asking me, since the share price are going down, should we wait or should we buy as per the Feb list? This is in the context of advising you to keep some money for future. No, I think I will answer this question. I will end this session by answering that question only. How much cash, when to deploy? I'll answer that. My understanding of market is, as the buyer buys the shares from the market, the seller gets the money from the buyer. In no way the money or profit traded in the stock market goes to companies whose shares were bought or sold. In such case, when profit or loss is only shared between the buyer and seller, how does the company benefit in this transaction? How does the transaction add value to this company? Who benefits in this deal in the larger interest of the society? So the point is very simple. Let's say uh, you are asking me like why buyer is buying the stock and the money goes to the seller. There is a company. Try to look at this way. Let's say you have a land. Let's say you have a land. To buy the land, you don't have money. Let's say you want to buy 10 acres of land. In that land, you want to do farming. But you don't have money to buy 10 acres of land. So what you did is along with 10 friends, you bought a land. 1 acre each. So you put it as a one company. 10 acres, 10 friends. So 10 shareholders, equal shareholders. So 10 parts in that company. So you are not getting land. You are getting 10% ownership in that company, which has got 10 acres of land. Now one friend, now you are doing farming, you are making income from that farm. Let's say you are making uh, 1 crore per year. 10 friends, equal amounts. Each of you are getting 10 lakh rupees as dividends, because 10 lakh rupees is the what you are getting in profits through farming. Now suddenly one friend need money. He want to sell his ownership. So other friend, he called some other friend and said, see, I have this farmland, 10 acres of land. This is what I am getting as income. So you are buying, if you buy my shares in this company, you will get land, you will get this income also. Then he will think, okay, what is the price? So, okay, 10 lakh rupees is what he is getting. 1 crore divided by 10. So 10 lakhs. Okay, what should be the value of land? What should be the value of these earnings? He will think, based on that, he will do the valuation. So he'll accept, let's say he accepted, okay, I'll pay you 2 crores. Give me that ownership. So he gave me 2 crores. He got the ownership. Now this transaction is done. Everyone's ownership's value has become 2 crores. Because one transaction happened at 2 crores. Now from here on, everyone's transaction will be at 2 crores. This is how the share price is decided. Got the point? This is how the share price is decided. So here the company directly is not getting any benefit directly, but the company is created by the owners. You, me, whoever buying the stock, we are the company. If I bought shares in Mahanagar Gas, I am Mahanagar Gas. I am the owner, part owner, not a big owner, but I am the part owner. I have share in the company's profits. I have share in the company's assets. I have share in everything. So I am buying that share in the business. If the business is growing, the next fellow whoever will be buying from me, he has to pay higher price for me to get that ownership. So how does the company benefit in this transaction? The company is not an individual. We as individuals are company. In the first example, I said 10 friends started a company, they bought a land. Land is not the company. 10 friends, they are the company. Land is an asset in the company. So company belongs to the shareholders. So shareholder is benefiting, right? I am There are 100 shareholders. This 100 shareholders, if they sell to remain next 100 shareholders, the ownership is transferred to the shareholder only. So the ownership is transferring within the shareholders. I will be a shareholder. If I sell, someone else will be the shareholder. So how company is benefiting? There is no company as such. Company is just a legal entity. People are to whom the company belongs. So that is one. So, but if you ask me how the company benefits eventually, since it is listed, if they want to raise additional capital, they can sell additional equity. So, with this mechanism, additional equity will be raised eventually that a private company may not be able to do. So, only benefit of being a listed company is the company can issue as many shares as they want, but new shares are also bought by shareholders. That is one. How does this transaction add value to the company? I think you are looking more from company's point of view. It is not the company, it is the shareholder. So we are not, you are asking me how the government is getting benefited by constructing roads. It is we who will be getting benefited. So you should understand the use case of it. Why would anyone put a company for the sake of company? The owner should get benefit out of the company. We are the owners. You are asking me what benefits in this deal is in the larger interest of the society. Let's say Reliance Industries, a company, has got, has generated, let's say, uh, has created, let's say, 10 lakh crores of wealth, let's assume, in the last whatever history, now its market cap is somewhere around 20 lakh crores. So 20 lakh crores is created by Reliance Industries. Now you tell me what benefit, how the society got benefited out of that 20 lakh crores? Obviously, jobs have been created. Who created? Ambani is the one who, uh, you know, uh, initially started the business. Later on, the shareholders gave their money and bought ownership in that company. So because of that, how many jobs they have created, how much tax they have paid, GST, income tax, so on, so forth, how many businesses they are dealing with, how many suppliers they have. So you can see the larger interest. This is how capitalism works. In capitalism, we don't look at company benefit. We look at the capitalist benefit. We are the capitalist. You might have only 10,000 rupees. You might have 10,000 crores. End of the day, you are also a capitalist. You are an investor. So if company makes money, investor gets benefited. If investor gets benefited, the society gets benefited because we pay taxes. We pay GST, we pay income tax, we pay capital gains tax. So in this, half the society is getting benefited. If I am not making money, who will pay tax? So we are paying taxes, which is in turn benefiting the society. But I think what you are looking at is you are treating company as a separate human being. No, company, if the humans doesn't exist, company also doesn't exist. So you have to think in terms of shareholders. We are the owners of the business, so think through shareholders point of view, then you will get more clarity. Market is falling. I think my portfolio is 25%. Okay, is it the right time? I think, Kiran, I think most of you are asking me the same thing. So what will be the cash position or what is that? I think I'll cover that in the evening. I'll cover that. I am 84, but believe me, I'm not disheartening or in panic by the recent crash. What I want is your replies to below queries. Which of the two options below is better? With many big falls in recent weeks, having lost 8 lakhs or 12 lakhs over last 2 years, uh, over 12 lakhs over past 2 years, is it prudent to exit all 29 stocks of my portfolio and salvage whatever is left? I want to reinvest once there is further fall, or when you recommend, can I still hold the stock still is further fall of 25% of my investment amount as I trust? Can I wait? I can wait for 2 3 years also. I think somewhere maybe last 1.5 2 months, or I don't exactly remember, but I mentioned that you book profits and keep it in 50%, whether you did that or not. In case if you haven't done that and you are saying I can wait for 2 3 years also, so in case if you can wait for 2 3 years, now the point here is exact predictability is very difficult. Full exit, I am not even saying like full exit. I already mentioned half exit, like 50% exit I mentioned long back. So if at all you want to do, you can half 50% exit, because if it falls, you can add. Uh, if the market goes up from here, at least you can recover. So any which way, the best strategy would be like having 50% invested, 50% in cash. 100% in cash. If the market goes up doubles, triples from here, you will miss an opportunity. If market falls 20 30% more from here, then it would be, you might panic, or anyone might panic. So my suggestion is 50% cash, 50% invested. That is what I am saying for long time now. 50% cash, 50% invested. I think most of the questions are from the same thing, like market is falling, should I sell, should cash, how much? So most of the questions are regarding that. I find that investor usually do not match with your excels. Therefore, I request excels research. Secondly, most Vinod Pasi, that question you can, I mean, that you can ask with the team. They'll share it with you. Like whatever the research report, Excel and all that, they'll share it with you. Secondly, and most important is that most of the stock repeated in monthly lease. Yes, the revised research reports and Excel Friday should be shared, not the reports generated. The revised research reports, Excel sheets as on Friday, first Friday of every month should be shared. You mean revised research reports? No, I mean you don't really understand the research report part. Okay, research report is actually not mandatory for me to share. I am sharing it so that you get conviction. It is not like I am going to revise 30 research reports or 40 research reports every month. It's not done. I mean, it's okay you are asking me, but technically you see it's not going to change anything. My rationale didn't change. My point of view didn't change. Nothing really changed. Why would I revise the research report if nothing changed? Point number one. Point number two. Research report is only a compliance part. It's not a mandatory part. Research report, or for example, I am recommending Mahanagar gas. What I can do is in the Telegram channel, I can just keep as buy Mahanagar gas. That's it. Recommendation is done from my end and done with SEBI also. Research report is for SEBI, not for actually for the clients. I am sharing it with you so that you will understand the logic behind sharing the recommendation. And you are asking me to update every research report. Let's say the list of 19. Do you even know like how much time it will take for me to write one report? If I keep on writing, then I think the monthly report cannot be provided. No, I mean, you think in terms of I mean, if I am writing a report, it is taking me 2 3 days, 17 stocks, 17 reports. That itself is 45 50 days for me. So it doesn't work. So revise, you are asking me, not the reports generated 4 to 6 months back. The same report is valid till the target price is triggered. Compliance part. For example, I gave you a stock at 200, and if I gave you a target price of 600, that research report is valid till the price is triggered to 600. For example, if it takes 8 years, let's assume the stock takes 8 years to trigger that price, my research report is valid till 8 years. That is what uh, that is what it says. So revised column should be CMP, buying price, MBP, MSP, etc. No, I'm sorry, but I am not able to do that because you are not really understanding how much time it will take to write a report. Point number one. Point number two, it is not required. And SEBI is asking us not to write a sell report. You are asking me a revise report. SEBI is stopping me from writing a exit report. For example, if I write a buy report on Mahanagar Gas, now SEBI is saying don't write a report, don't give any exit calls. Now we have stopped. That is the reason I am using MSP. This MSP is nothing but maximum selling price. We have included this maximum selling price in this recent research report. The reason for that is SEBI is stopping me from writing one more report. Now you are asking me for every recommendation write a revised. Again, SEBI will not allow me that. What SEBI? I will not do that because my rationale never changed. If my rationale is changing, then the entire logic of me giving you a buy recommendation will change. From buy it might become a sell. For example, you see Mahanagar Gas. Now, for example, Mahanagar Gas, what is my logic for recommending Mahanagar Gas? I think the allocation that happened recently from the government, that allocation has gone down, which I think is cyclical. Now, once that allocation reinstates back, so the margins will go up, the net profit will go up. Obviously, it's a positive uh, phenomenon for the company, so market will react positively, so the share price will also go up. So that is the logic. This is the only logic. If I am giving the stock today, 3 months from now, 6 months from now, this is the logic. So logic, how do you think the logic changes? I have to write the same report again. Mahanagar Gas also, I think I recommended 2 months, 3 months back. This month also it will be. Most probably next month also Mahanagar Gas will be there. So how the logic will change? Rational will not change. So what I mean to say is research report will not change. Only once I have to write. And the research report is valid till the target price is triggered. For example, GSPL report, let's say I wrote 8 months back. And if the target price is not reached, someone joins with me, let's say after 1 year, I'll share the same report with him and that report is valid because the target price is not triggered. My rationale didn't change. So it's already 12:35, I guess. So what we'll do is we'll go for lunch break and then maybe we'll be back at, it's already 12:35. So we'll be back at 2 o'clock. So then we'll start with when to buy, when to sell and all. So what I'll do is I'll run a timer here. 1 second. I will run a timer for how much time? It's 1.5 hours, right? Okay, 90 minutes. So I'm not ending the call. The call is active here. So I will start a 90 minutes timer here. And once the timer is done, most probably it will be 2 o'clock. So then we can start the session again. Chalo. Check, check. Guys, can you hear me? Am I audible? Please raise your hands if you can hear me. Okay, I can see people raising hands. Chalo. So I can see people are joining in. So before we start, I just even my team also just mentioned that they are receiving some queries regarding the same research report related queries. So I felt there is some confusion regarding the research report. So let me clear that and then I'll start the session. So let me show you this. So basically this is our research reports. So generally this is our format. I mean each research analyst will have his own format, but this is our format. But there are few uh, mandatory requirements from SEBI. Now content I can write whatever I want, but there are few mandatory requirements. I think once you understand that, maybe then the confusion will be cleared. The first thing is obviously the date. So in the research report, I have to mention the date, of course, the company name, code, and all. So I have to mention what is the current price, what is the target price, and what SEBI notice is this: buy, hold, or sell. So for example, with Mahanagar Gas, 18th November 2024 is when I published the research report. And it was a buy report. And this is a brief rationale which is mandatory. For every research report, you will find the same thing. Because when I got the license, I should mention with SEBI like what is the process that I'm going to follow whenever I am recommending a stock. For example, if I am an options trader or if I am doing F&O and all, the process will be different, the strategy will be different. So I have to mention it with them. While I mean, whenever I got an interview with SEBI, this thing, I mentioned I'll recommend stocks based on the valuations. So my rationale will be on valuation. So if it is undervalued, it's a buy. If it is overvalued, it's a sell. So my rationale will be same for all stocks. That is valuation. Then comes obviously this is what I mean. This is my thing. Each analyst will put his own thing. And again, in the end, there will be again a buy this thing. And these are the disclaimers, obviously, and all. Again, that is also mandate requirement. And this is very important for SEBI. That is a digital signature. So this is Aadhaar based signature again. So signed and dated. On you can see the time, you can see the date, you can see my name, and this is a digital signature. So I think the confusion is there are three people involved. One is you, one is me, and the third is SEBI. Now, according to SEBI, I don't need to share this document with anyone. This is for my internal use. For me, this is the document of proof. This is my documented proof. I can recommend wherever I want. For example, if someone calls me for an interview, I can just go to an interview and I can say, buy Mahanagar Gas. That is a recommendation from my end. But what SEBI asked me is a proof of document that you have done research, you have a rationale, and you have signed the document on that date or before speaking anywhere else about that stock. So 18th November 2024, 8:31. I can speak about Mahanagar Gas on that day or after the report has been signed. But on 17th, if I spoke about Mahanagar Gas, I will be penalized. So SEBI will impose a fine saying that on 17th there was no document. On 18th there is a document. So why did you spoke on 17th? So if I have to speak about any stock openly in public, either on that day I have to write a document or I have to write a document first, then I can speak about the stock. So I am sharing it with you so that you get a confidence on what rationale I have followed. But for me, it is a proof of document. For SEBI, I have to maintain this register. I think I never mentioned this, but I have to maintain a register of all my recommendations. So whether it is a buy, of course, I gave few sell calls, but these days SEBI is imposing a fine also if I write a sell call also. So what SEBI is saying that you need to write only one report. That is a buy report. There shouldn't be any follow-up report. So what I started doing now is this. Recently, what we have done recently, I think we gave last, okay, yeah, last week only we recommended a stock. Let me share that file. So this is Vindhya Telelinks. So we shared this last week. Now here we have added few things saying like this target price MSP is something that we have included for the first time. The reason is pretty simple. SEBI doesn't want us to write a follow-up report. So I have mentioned everything in the single report itself. So this is the maximum selling price. So this is where you will start your profit booking journey. 3,300 is where you will start. 3,000 around 4,000 is where you will end your selling journey. Now why I have to include this is because SEBI doesn't want me to write a follow-up report, which we used to do previously, but SEBI is saying that that comes under hand holding. So whatever it is, so hand holding is not permitted, and they said like you write everything in a single report. Now what some of you were asking is like the date. So the team just mentioned that uh, the date for the older research reports were 2024. So can you just change it to 2025 and reshare it? That cannot be done because according to SEBI, I can only write one report on a stock. So Mahanagar Gas, I have already written a buy recommendation on 2024. Now, how can I write a separate report? If at all I have to write, I have to write a sell report. But SEBI is saying you don't write a sell report. So already there is a buy report which is valid, which is active. I cannot write one more buy report. And of course, the dates and all, the digital signatures and all, they'll change. So this is a proof of document. So which document is my proof? Whether it is 18th or whether it is current 2025. So it is not valid. So I think that is where the confusion is. Research report is only for the internal purpose. I am sharing it so that you get confidence. So please don't get confused that we'll write multiple reports on the same stock. We can write only one report is according to SEBI. That is also recently 7 lakhs penalty is what one of the research analysts got imposed. Only then we realized that we should write one. Otherwise we were writing buy report and we were writing sell report also. So now we don't want to take any risk. So that is the reason we are mentioning all the exit prices also in the report itself, so that there is no need to write another report. For these stocks, of course, MSP you don't know, right? So what we'll do is from next week onwards, I mean every weekly mentoring program, we will take some stocks. That is our previous recommendations, and there we will let you know what is the MSP of these stocks. So we'll do analysis and then I'll let you know what is the exit 1, exit 2, exit 3. And by that way you will get to know where you can exit each of the stocks. So this I'll continue for some weeks. By the time we complete our entire recommendation, whatever we are done, I'll do MSP is nothing but maximum selling price. So I'll give you exit price of all the stocks. So I hope you got the clarity. We cannot write multiple reports on the same stock. And I can write the same buy. Like for example, you see this Vindhya Telelinks. On Feb 7th, we gave a report that is buy. Next month also, this stock will be in the list. So should I write a separate report again saying buy? Then SEBI will ask me like why you are writing a buy report again, which you have already written. So I will, let's say for next 6 months, I have to write 6 buy reports again. So SEBI will ask me which is the valid report and why you are writing all these reports. So one report is what required. So proof of document should be one. I need to have one Aadhaar card, not 6 or 7, right? So this is something like that. So when SEBI comes for inspection, I have to show this register with them, like what stock, what is the date, where I have shared it, what is the call, whether I have created a research report or not, and did I sign it or not. So digital signature is important. So this is the record we have to maintain. So I cannot write, for example, GHCL is a buy on 15th October 2024. That's where we have given the buy call. And that is where I have written the report. Again in November 5th, I cannot write the same GHCL and buy. I cannot do that. So I hope that clarifies your question. So Now let's look at when to sell a stock. Okay, when to buy a stock and when to sell a stock is where we have stopped. So chalo. So once the valuation is done, so here for Mahanagar, we got, let's say, 1537 as our intrinsic value. Now, should I buy the stock exactly at that price? No, generally what we do is we apply a margin of safety. Now, what exactly is margin of safety? You can call you can call it as an insurance against human errors. As you already know, we are making a lot of assumptions, and those assumptions are related to future. So no one knows whether what we have assumed will materialize or not. So there is always risk involved. In every assumption that we input, there is risk involved. How to mitigate the risk? We cannot completely, like, 100% remove the risk from the valuation. But what we can do is we cannot we can ignore that 1537 at face value, and we can say, okay, let's assume there is some error that we have done. So let's apply some margin of safety. So it is like, for example, uh, I always give this example, like, if you have to build a bridge that carries 10,000 tons of weight, you definitely build a bridge that can carry much more than that. So that is margin of safety basically. Similarly, 1537 can be right, or there can be an error. So we cannot trust that number with 100% faith. So we want a discount to that number. If the stock is trading at a significant discount, then we can feel that, okay, even if we make some mistakes, also we'll not lose money. Now, what should be that percentage? Should it be 10%, 20%, 40%, 60%? What should be that percentage? That margin of safety depends upon what kind of stock you are investing in. For example, if it's a loss-making company, absolutely bad business, bad history, then you need a bigger margin of safety. Big discount is what you will be expecting, because anything can happen. Things can go down south pretty quickly, and you can incur permanent loss of capital in those stocks. Generally we don't invest. Generally we don't invest in such stocks, but if at all someone wants to invest, for them 60-70% discount should be expected. For example, if such stocks valuation, let's say, value is 100, you should pay 30 or 40, not more than that. So 50-60% margin of safety is expected from that kind of stocks. But as you know, in our process, we are not investing in extremely risky businesses. We either look for low risky or at least moderate risky investments, not high risky. So in our case, 50% margin of safety is not required. So what I do is, basically, instead of having one margin of safety, we will have three entry points. Now the first entry point is a 10% margin of safety. For example, 1537 is the intrinsic value of a stock, but we don't want to buy at that price. So my first entry would be around 1383. That's the first entry. The second entry would be at 20% margin of safety, which is 1229. The third entry is somewhere around 25% margin of safety. So as you can see, I am in this case, I am not trying to buy the entire stock at once, but I am trying to buy it in phases, in three phases: 1, 2, and 3. First is at 10%, second is at 20%, third is at 25% margin of safety. So that is how I buy a stock. Exactly same process we apply for selling the stock as well. Now here, whenever I am buying a stock, I am looking at margin of safety, which is a discount. Whenever I am selling a stock, I am looking at premium, not discount, but I'm looking at a premium price. Premium to what? Premium to my intrinsic value. So whenever I'm exiting my first exit, I want to keep it at a very, very reasonable and conservative price. So first exit, I am considering weighted average intrinsic value, which is 1500. To that, I am expecting a premium of 25%. So my first exit is at 1921 because 1537 is my intrinsic value and a premium of 25% to that is 1921 rupees. That is my first exit. But for the second and third exit, I am being very aggressive now. Now, because I have already booked some profit here. So I bought at this price 1239. I sold some quantity at 1921. So I made profit. I booked some profits. Now I want to ride this stock. I want to get some speculative return as well. From extremely undervalued to extremely overvalued is what I am looking at, that journey. Since I have already booked some profits, now I can hold it for a little longer term as well. Now my second exit, I won't consider this weighted average because like I said, I want to be aggressive now. So out of all the valuations, I look at which is the maximum expected value. That is 2700 here. So 2700 can be the maximum. Like I said, valuation is a range. So in that range, minimum is 900, maximum is 2700. So that can be the range. So in the best case scenario, 2700 can also be the value of the stock. If the margins expand, if the revenue growth is much higher than what we have anticipated, 2700 is also possible. In that case, I will take that 2700 and I'll apply a 35% premium to that. Take this and apply a 35% premium, you get entry exit 2. For exit 3, I apply the same concept. 2700, I take a 50% premium to that. So entry, I am asking for a discount. Exit, I am asking for a premium. First exit, I am being very reasonable. For the first exit, I am only asking a premium for weighted average intrinsic value. You give me that, I am okay to exit some quantity. But for second and third, I am being aggressive and saying like for second, I want, tell me what is the peak valuation, like what is the most expensive valuation that you have got. Give me a premium for that. So 35% premium to that and 50% premium gives me 3 exit levels. Obviously, here we have 3 entry levels. So this is how we buy and this is how we sell. Now so far whatever I have discussed from the morning to this point, everything we discussed is about the stock specific process or stock specific analysis. Now this way, now this is for Mahanagar Gas. Maybe I apply the same process for, let's say, some other stock A, stock B, stock C, stocks D. So I apply the same process for multiple stocks because I want to create a portfolio. I'm not going to invest all my capital into a single stock. Why? I mean, what is the logic? Why I don't want to invest all my money into Mahanagar Gas? Because you can say you have done so much of analysis. Now you are confident on the business. You are confident on your valuation as well. And it seems to be undervalued. Significant margin of safety is also, we can see. Then why not 100% into this one stock? The point is very simple. Like I already said, whatever we are assuming, it is all regarding the future. And if you invest 100% of your capital into a single stock, risk is also 100%. For example, what if tomorrow the government changes all the policies and says like no exclusivity, all the private players can join and we don't give any allocation. From now on, 100% you have to buy from the spot market. So if that is the policy, then Mahanagar will take a hit. So there are many things. I mean, anything can happen like accidents or anything. I mean, there can be 100 events that can affect the business, which we call as black swan events. So if something like that happened, the Mahanagar share price can go down. So if I invest 100% of my money here, all my capital is at risk. But what if I invest in two stocks? Now that's a 50-50. Now the risk is distributed. Four stocks, it's 25-25. So risk is distributed with four different stocks. So as the number of stocks increase, the risk in the portfolio will reduce. That doesn't mean you will have 100 stocks in the portfolio, because if you have 100 stocks, obviously the risk is minimal, but the return will be affected. Even if you have a 20 bagger, 30 bagger in your portfolio, it won't add anything to the actual overall portfolio, because that is just 1% of your portfolio. So it will affect the returns. So you need a number where the return is elevated, risk is mitigated. So we call it as optimizing the portfolio. You need to have the optimum number of stocks to maximize the returns and minimize the risk. So what exactly is that number? Now, of course, I have gone through multiple books, multiple research studies and all. Even after applying it in my own portfolio, trial and errors, testing and all, I realized 15 to 30 would be the best number. 15 to 13 depends on the capital, depends on your age, depends on your risk appetite. The best number would be 15 to 30. But generally, what I do is I am not really into numbers, whether it is 21 or 24 or 16. I am not really into numbers. What I personally do is I limit myself from investing more than 7.5% into a single stock. So the maximum I go and invest in a stock is only 7.5%. Rarely, very rarely, not with every stock, it's an exception, not a rule. Rarely I may go up to 10%. That is also very rare. But I want to maintain maximum of 7.5% into a stock and a minimum of 2.5%. For example, if I am entering a stock, let's say I have 1 lakh rupees. Let's assume I have 1 lakh rupees and I want to build portfolio with this 1 lakh rupees. So in one stock, the minimum I am investing is 2.5k. That is 2,500 rupees minimum. That is 2.5%. The maximum I'll invest is 7,500. So in between 2,500 to 7,500 would be what I will allocate in a single stock. Now you look at uh, this in terms of what will be the number of stocks. For example, if I invest 7.5% into all the stocks, then I'll have maybe around 13 stocks in my portfolio. 13 to 14, I guess. 7.5% into all the stocks. So the minimum number I can have is only 13 or 14. I cannot go below that, because I'm not going to invest 10% into all the stocks. If I do that, I'll have only 10 stocks, but I will only limit at 7.5. So maximum 7,500 if my capital is 1 lakh. So minimum I'll have 12, 13, 14 stocks minimum. If I invest only 2.5% into all the stocks, then I'll have 40 stocks. So in any given time, I cannot go below 12 stocks. I cannot go above 40 stocks. Whatever I do, I'll be in between this number. Even if I invest 2.5 into every stock, I'll have 40. 7.5 into all the stocks, I'll have 12. So 12 to 40 is my range. But generally, I'll not invest 2.5 into all stocks or 7.5 into all stocks. I'll keep it in between. Somewhere in between. Some stocks I might have 2.5%. Maybe in some stocks I'll have 5, in some 7.5. That is what I would do. I would do that. But eventually, initially I started that way. But eventually, what I realized is equal weighted portfolio worked much better than all of this. At least for me, like what I have seen, at least in the last 3 years or 4 years. Previously, I used to be very careful with all this 1, 2, 3 and all. But eventually, what I realized is equal weighted portfolio without all this, what I would say, adjusting and balancing the portfolio and all, equal weighted portfolio worked tremendously. I'll give you an example. Let's say there is stock A and there is stock 1, there is stock 15. Now in this ranking, generally what happens is based on expected returns or based on margin of safety, you create a rank or multi-bagger gains, whatever, you create a rank. There is rank 1, there is rank 15. Now generally we are greedy, or at least I was greedy. So what I used to do was, okay, this is rank 1, this is rank 15. So rank 1 stock deserves more capital than rank 15. This is what I would feel. And I invested a little more or significantly in stock 1, and I invested very little in stock 15. 2 years, 2.5 years later, stock 1 may have gone up 4 times or 5 times, which is good. I'm happy. But stock 15 went up 20 times. It's a 20 bagger. And I invested very little amount in that stock. Just imagine if it was an equal weighted portfolio, my portfolio's return would have been tremendously high. But I put more in one, very little in 15. So that really impacted the overall return of the portfolio. I made 20x, but my capital was very little over there. So that is something which really affected my perspective of building a portfolio. Then after I feel like it's always better to have an equal weighted portfolio. You pick a number, let's say 20. Invest 5% into all the stocks. Let's say you want to invest only in 15 stocks, maybe 6% or something like that. So 15 to 30 is what I would suggest. Any number you pick and you invest equal amount, depending upon the ideas. For example, right now we don't even have 30 ideas. We only have a maximum of 20 to 23 ideas, right? So you can pick that number, then go for equal weighted. So something like that. But for senior citizens or for someone who is investing a lot of capital, when I say lot, I would say more than 25 lakhs or 30 lakhs. If your capital is more than 25 lakhs, then it's better for you to go for a 30 stock portfolio. Because when you have huge capital deployed into the market, stock market fluctuations are really wild. And you are only tuned to absolute numbers. You don't look at 1%, 1.5%. You actually look at like how much amount is gone. For example, you invest 1 lakh rupees, 1% down, 2% down is only 1000, 2000. You feel like, oh, 1000, 2000, it's okay. But when you invest 25 lakhs, 1% is 25,000, 2% is 50,000. So you feel like you feel a lot of pain. Okay, my monthly salary is gone or something like that. So it's better for you to have a 30 stock portfolio so that the fluctuations are not sharp and the returns are also not compromised. So for someone who is investing more than 25, 30, you better maintain a 30 stock portfolio. That is one. The second thing, if you are a senior citizen, let's say above 50 or above 60, 60 and all, 55, 60 also I'll consider. Above 55 if you are, then better you go for a 30 stock portfolio. The reason is again, huge, most of the people who are past 30, past 60 are mostly retired. So again, huge fluctuations in the portfolio is something that would really worry you. So again, to dilute uh, risk even further, you can go for 30. Only in these two situations. Either if you have a decent big capital, go for 30 stocks. If you are senior citizen, go for 30 stocks. Remaining, if you are young, if you have let's say 5 lakhs or 10 lakhs, you can go for a 15 stock portfolio. But whatever you do it in equal amounts. Maintain an equal weighted portfolio. That is one aspect, which is the number. The next thing is the number of industries in the portfolio. This also matters. For example, you have 20 stocks in the portfolio. Now, in that 20 stocks, 10 stocks are from IT, 10 from banking. Now, you tell me, Do you really think it is a well diversified portfolio? You invested only in two industries. Something happens to banking industry, 50% of your portfolio is gone. Something happens to IT, the remaining 50 is gone. So it is like investing only in two stocks. You might have 20, number is 20, but technically you only have two stocks. So my suggestion is a minimum of five industries, five sectors, minimum. Maximum that is up to you, but minimum five sectors, which means maximum of 20% into a sector. For example, if you are investing in IT, in your portfolio, you should not have more than 20% allocated to that industry. Less than 20 is fine. Less than 20 is fine, but more than 20, no. Banks should be less than 20% in the portfolio, or any chemicals less than 20%. FMCG less than 20%. So minimum five sectors you need to have. Maximum there is no limit. Let's say you have 20 stocks, 20 from different sectors, it's okay. Because with high quality, we are going for high quality stocks, right? So with high quality and with valuation and with diversification, what we are trying to do is there are two types of risk. One is macro level risk, the other is micro level company specific risk. Economy specific and company specific. Margin of safety, high quality stocks, we are using this to mitigate the company specific risk. For example, Mahanagar Gas, it's a high quality company. Valuation is also decent. There is a margin of safety. So we are trying to, mitigate the company specific risk, but have to mitigate the economy specific, market specific risk through diversification. Number of stocks also help. Diversified industries also help to mitigate that risk. So minimum five sectors. And within the valuation, one more point that I want to cover is have to value a financial stock. Again, more or less the same process, but only small difference. For example, of course, Axis is also one of our recommended stock. Now, more or less the analysis part is the same. But the only difference is whenever you are analyzing a bank, cash flows are all over the place. Because you need to understand any financial company. It can be a bank, it can be a housing finance company, it can be a microfinance company, insurance company, any company. You need to understand there is no product. What product does bank is selling you? There is no product. You give them money, you deposit your money, they pay you interest. How they are paying interest? They give that money to someone as a borrowing. They lend the money and generate 10% interest. They take the money from you and pay you 6%. That remaining 4% is net interest margin. That 4% is their business basically. So cash coming in, cash going out, there is no product, no capex, nothing. So cash flow based valuation may not work. For example, if you look at Axis 9,190. So as of now, the cash flows are positive. But this may not be the case. I mean, you cannot even trust those numbers. And if you ask me what is that, we don't know. Because if you go and check banks, let me show you. For example, at HDFC Bank, go and check the cash flows. You can see all negative, positive numbers. ICICI Bank. You can see there are negative. ICICI there is positive, but again, since it is positive, it is best. It's not like that. Cash flows are pretty random for banks. So IndusInd, you can see negative cash flows, negative cash flows. So for banks, housing finance companies, all these companies, cash flow based valuation doesn't work. So what we do in this case, there is a DCF. DCF valuation says 738, 998. Okay, it seems reasonable. No, you cannot even trust this number. You don't know like what number is that. It can be random number. So what would be the best way to value a financial stock? When I say financial stock, it can be a bank, it can be housing finance company, it can be microfinance company, whatever. It's any financial stock. we ignore these three valuations. Here it is positive. Just because here it is positive doesn't mean that every financial stock will be positive, or you can take these positive numbers and value. No, you have to ignore them because we don't have any confidence on those numbers. They cannot be trusted. Cash flow based valuation doesn't work with the bank. So what I do is I only look at these two valuations because these are earnings based valuations. So here you can see the earnings are positive. Net profits of the company, you can see they are positive. So you can take these numbers. So based on earnings of the company, you can see here total returns is 1930, PEG is 1151. So what should I take? Very simple. First, let's remove this. Here, I just want to take a weighted average. Previously, I used to give a 20% weightage to all the stocks. Now, what I am doing is I am giving a 50% weightage here, and I am giving a 50% weightage here. So you see 1541. But of course, I have inputted a formula so that you can understand the concept, but that is also not required. For example, you can just take average. So average of these two numbers, that's it, 1541 is the value. And of course, same process, 10% margin of safety is 1, 20% is 2, 30% is 3. This is the buying side. That is the buying side. Selling side, don't ignore. Now you can see here, first exit is computed using weighted average intrinsic value. What about the second? For second exit, the file is using this number, which, I mean, that number we shouldn't use because these three valuations we cannot trust. So what I will do here is I will only use these two valuations. So this is the maximum, right? So for this also I'll take this. So 1930 should be my maximum value, not 2300, because these are cash flow based valuations. Now, what one more shortcut I can show you is very simple. So for example, I am just undoing the things. So what I'll do is 3200 is from this. 3500 is also by taking the 2300 as highest. So what we can do is you can just go to cash flows, and if you just one second, one second, one, okay, it is 9000 into, okay, let's keep it like that. So you can just take it from here. If you just remove them, it is automatically adjusted. So it will directly take this if you just remove them. But of course, this may not be the case with every company, but with Axis, these numbers are positive. So since those numbers are positive, it is affecting the exit price also. But with majority of the other banks or other financial companies, mostly these three numbers will be negative. So either you remove them or you can just use this number with 1.35 and 1.5, and you can adjust. So that is what we do with a bank, because cash flows doesn't work with bank. So now let's look at one second. So since morning, like, so I mean, most of the questions were regarding like what should be, have to allocate the cash and all. So we'll cover that one second. So chalo. So will market crash in 2025? I think some of you already think that it is crashing. So the portfolios are down. So most of you are already feeling the pain. And if you look at in general, the pain is much bigger. Because just imagine what someone's portfolio would look like when invested in overvalued stocks. So the pain is much, much bigger. So, of course, these are little older slides, but the market is down, and you know that. The point is whether it is a buying opportunity of sign of crash. Every day, the same question keeps on repeating. When in some, I mean, in few situations, it may seem like okay, it's a buying opportunity, and suddenly looking at few other things, it may feel like okay, the bottom is yet to. The bottom is yet to reach. So it's a question of whether we need to add here or we need to wait, which no one really has got 100% clarity. But what I personally do is I want to position myself in such a way that where I can have some kind of an advantage over the market. For that, gaining that advantage, I am looking at two scenarios: upside potential and what is the downside risk. Now, first let's look at the downside risk. If you look at the previous drawdowns, which is the 2008-9 like housing bubble, so large cap, I have rounded the figures. So large cap crashed around 60%. Mid cap index crashed around 70%. Small cap index 77.5%. Now you just compare this with the current crash or current fall. How much did Nifty fall? 12%, 10%? How much is that? Compare that with 60%. Do you think what is crash? What happened? 12% if you think is a crash, then what is 60%? Just imagine. Chalo, leave 2008-9. Let's look at COVID pandemic crash 2020. Nifty or Sensex dropped by 35%. Current drop is only 12% or 10%, right? What will happen if the market drops 35%? So how much fall is left according to you? Significant, right? Mid caps 40%, small caps 45% fall happened during COVID. This is index, not individual stocks. Index, entire index. So for example, Nifty, if you are looking at Nifty, Nifty maybe is down around 10% or Sensex is down by somewhere around 10-12% or something like that. So if it is, yet to fall near these levels, what would be the situation? Now that is the downside risk. I'm looking at the downside risk. I'm not saying Nifty will fall 40% or 60% from here. I am no one to make such statements because I don't know the future. But I'm just looking at the downside risk. That is the downside. You can expect 20% or 30% or 40% also from here because it has happened in the past. Something that happened in the past can also repeat now. So that is the downside risk. So will the stock market crash in 2025? That is the current year. We can check many things. For example, Sensex or Nifty PE ratio you can check, or price to book ratio you can check. Market cap to GDP is something that I am using much more than what I used to use before. Like I am using it for like 3 years or 2 years now. 3 years, I guess. Before that, also I know market cap to GDP ratio, but I was not really concerned. But I think it's after looking at its history and tracking it with how stocks or overall market performed in line with the market cap to GDP, then I realized okay, it's a tool that is really helpful, which I ignored, but now I started using it much more than what I used to do. PE distribution, I think I've mentioned that many times. India VIX is that fear indicator. Now, something that I don't place too much emphasis is Nifty or Sensex P ratio or price to book ratio. I'm just mentioning it so that you can also go and check. But I don't have any confidence on this particular thing, because 2021 before they were using standalone numbers, the current numbers are consolidated numbers. So it's not apples to apples kind of comparison. So let's ignore Nifty and Sensex P ratio. But there is market cap to GDP ratio which we can check. So Buffett indicator, some you were asking me in the morning when I was going through the Q&A, you were asking me like, should I add NAV? Like I have some money, should I add it NAV or should I wait? See, I'll tell you my opinion. So where I would like to enter with whatever capital that I have in the liquid funds, which I have already mentioned. So where I want to enter is 114 is the current, market cap to GDP ratio. So 114 is slightly overvalued. Let me show you. So here you can see modestly overvalued. 98 to 116 is modestly over. As you can see, these ratios are changed. Uh, Previously, this number was not 160. They changed it. Based on the market environment, they are changing it. So even today, it is more. Okay, sorry, I'm looking at the wrong numbers. So they didn't change. Okay, it is still the same. I'm looking at market cap to GDP plus total assets. But of course, they'll change these numbers based on the history. One more year added, the averages might change. So here you can see 90 to 110 is fairly valued. 110 to 130 is modestly overvalued. Above 130 is significantly overvalued. And here you can see currently it is at 114, which is here modestly overvalued. Now, where I want to deploy my capital, or at what point I would feel like deploying. This is where I want to deploy the capital below 90. Now, you may ask me, what if that doesn't happen? Vishnu, like you want to deploy when the market cap to GDP ratio is less than 90. What if it doesn't happen? Like, for example, from here, market directly goes from 114 to 120 to 130 to 140 to 160. It can happen. What if it goes up suddenly? Whatever extent it can go up, it has to fall one day. It cannot go from 114 to 450 or 1000. It may not go. It has to come back someday. So I'll wait. I have that patience because I'm investing for next 50 years, not for 5 years or not for 3 years. So I have like 20, 30, 50 years goal. So it's okay. I can wait. I can wait 1 year also. It's okay for me. So I want to buy here because if I buy here, the reason is pretty simple. I don't want to churn every now and then. If I invest when the market is below 90, if I am lucky enough at 70 or 60, then I can just ride the wave for next 5, 6, maybe 7 or sometimes 10 years also if it's an extended bull market. So less pain, more gain in that way. If I buy here and I expect if I buy here, I only have to expect the market to go up. I cannot, I'll lose all my purchasing power because I'll not left with any money if the market goes down from here. So I'm waiting. I can wait. I'm okay to wait. Or you may think like, what if it goes to 92, 93 and it comes back? That also I'm fine because 90 is only fair value. So at fair value or modestly overvalued or significantly overvalued, the expected returns won't be that high. So whatever I have in my liquid funds, that money I am only going to invest when it is in the modestly undervalued range. Significantly undervalued, yes, I am obviously looking for that, but at least here I would start deploying. Above 90, no, I'm not going to deploy. And when did that, if we look at the chart, when did that last ended, that range ended? For example, in 2020, it was just 58. So 2021, but I invested here. I am saying the funds that I have right now is what I would invest there. So as you can see, around 120. So for the last 4 5 years, it is always above 100. So for the something like COVID or something like crash should happen for the market to reach that 70 below or 90 below range. So what I am clearly expecting is a crash or a big fall. Only then I'll invest. So as simple as that. But here you can see the market was always used to be undervalued. So 80, all these years market was undervalued. Only for the last 3 4 years market was extremely overvalued, and as you can see there is some fall happening right now, and let's see where it will go. And distribution of P ratios you can check. India VIX is something that again you can. So it is somewhere around 15. So you can see slowly it stabilized. This is last 1 month. So it went up to 18.64. Below 19 is stable. So it went to that maximum, 18.64, and again it reverted back. And right now, looking at 15, market seems stable. This is the fear indicator. So the fear is not that high. But here you can see the fear 29th Jan. Fear is at the peak. People were panicked during that period. But now you can see some slowdown happened, stabilized. But of course, this keeps on changing. So it only takes 1 day for fear to again go back to 18 or 19. So what I am looking for is a favorable valuations. But I don't mean to say you sell entire portfolio and liquidate and stay in cash. No, because like I said, from 114, from here the market can go to 150 also, 170 also. So market can get extremely overvalued also. It can go this way or that way. So my suggestion to you is, so right now we are here. So it can go back to this extremely overvalued levels. It can go to fairly valued levels, or it can go to slightly overvalued also, slightly undervalued also. I am waiting for these levels. So whenever those levels come, I'll deploy my money, and I'll ride that wave for 5 6 7 whatever. I'm looking for that long term runway, and I can wait for some time also. I'm not in a hurry. But if it goes from here to here, this is the upside potential. If this happens and you sell entire portfolio, then you miss out huge gains. So my suggestion is, I think I have already mentioned this SIP 5 S&P 500. So based on that S&P 500, I think right now it's best to have 50% invested and 50% in cash. The reason is pretty simple. Let's say you are here, we are here right now, and I have 50% in cash. If market goes to extremely overvalued levels, whatever 50% that is involved in the market will perform. Of course, there you can start booking profits. It's a good news. Or from here, the market dropped and went to this undervalued or extremely undervalued levels. Of course, the existing 50% portfolio that will fall. But still, it's a good news for you, because now you can buy those extremely distressed stocks with the additional capital, that 50% capital you have, you can buy, and you can average down, and in the next rally you can just generate extremely high returns. So if you are in 50% cash, then wait for the market to enter here, somewhere around here. Don't buy the remaining capacity also here, then there is no advantage. If you are buying here, the remaining also, okay, this stock, that stock, you buy here, what is the advantage? That 50% should help you in averaging down today, or 6 months from now, or 1 year from now. You keep it aside. You only involve that money when the market is somewhere around here, not here. Let's say you don't want that pain, then you pray for the market to reach these levels, so that whatever existing portfolio that you have, let it get overvalued. You book profits and then get into cash. So I don't know where the market will go, but I think or I want, this is what I am waiting for. If it happens, I'll deploy my cash. If this happens, if this happens from slightly overvalued to extremely overvalued, then I'll just book profits. What's wrong in that? Either ways, I am in advantageous position. So I also want you to position yourself like that. 50% cash, 50% involved. If the market goes up, you book profits. If the market comes down into undervalued zone, then you start accumulating or averaging down whatever, you deploy the remaining cash. So for people who are asking since morning, I can see many questions. The same thing. Should I invest now? The market is down. Should I invest now? We have not, applied this process of keeping 50% capital away to invest here, 2% or 5% down. We are waiting for a very big fall, and I think that big fall will happen sooner or later. But market has to fall. It is inevitable, either today, 6 months from now, or 1 year from now, or 2 years. I don't know exact time, but market has to fall. There is no way. Market will fall. And whenever the market falls, this is not a fall. 10%, please don't say it's a fall. This is not a fall, because whenever you say this is a fall, I want you to look at this slide. Compare the current fall with this slide and you tell me whether it is a fall. It's not a fall. It's just a fluctuation. Whatever happened so far is just a fluctuation. The downside risk can be much bigger, is what I assume. But any which way, up or down, if you have 50% cash, then you can, even if market goes up also you'll be happy. Even if it comes down also, you will end up being happy. Eventually, may not be that day, but eventually in 1, 2, 3 years, you will enjoy the benefits. So pretty much that is what I wanted to cover in today's session. And of course, I want to take your questions. I'm sure you will be having many queries. Manla Ramaswamy, my capital is 5 lakhs. How many stocks take portfolio giving? No, I think I already mentioned, if your capital is 5 lakhs, 15 stocks is more than enough. Have to identify a stock before we do this analysis. No, I mean, we use screener.in, but have to identify a stock. I think I mentioned that process already, like we use screener.in. Have a fresh capital around 1 lakh, can we invest or shall I hold? No fresh capital. I guess I think I already mentioned, like don't invest fresh capital. Just whatever you have invested so far, let it run. I like reading books. Shashidhar is asking me, I like reading books. Please share books to read related to stock market. Now, since you mentioned you like reading books, two books, I think I already mentioned those two books. Let me mention again. Pat Dorsey, author name is Pat Dorsey. The Lil book that builds wealth is one. Book number two, the uh, five successful rules of stock investing. Both are from Pat Dorsey. You please read these two books. I mean, you will be a different person altogether. And of course, intelligent investor, but intelligent investor seems to be, you read commentary. Jason Zweig's commentary on Investor Diary, that uh, you buy intelligent investor, there is Benjamin Graham and a commentary also. Commentary would be more helpful because it is updated recently, whereas Ben Graham's thought process would be from 1945, which is little older, business models and all, which you will not understand. It's something boring also. So intelligent investor any given day, Peter Lynch, One Upon Wall Street, Monish Pabrai, Dando Investor. So there are many books. So, but overwhelming. First, you read two books. That is Pat Dorsey's two books. Mahanagar Gas, the company is not in Feb list. See, I mean, Feb list and all, it depends upon how the prices change. So it's almost 10-15 days now. It's almost like last week, I guess. So it's 10 days. So prices change. So share price falls or share price goes up. There are many reasons why a particular stock may not be in the list. So let me check. So yeah, I mean from 1400 it's right now at last week it was trading around 1360. Now it is trading around 1240. So that is the reason. That's the reason why it is not in the list, Feb list. Because share prices keeps on changing. Rishita Reddy, can you guide on entry level positions in equity research for MBA students on which companies hire freshers? It would be helpful. I mean, you mean internships? So, I mean, you can go for PPFS. You can visit their website, PPFS website, and there is a career option there. So you can just send your details over there. I mean, any mutual fund or something like that, you can. There is a career option. You can just go and check the career option. There you can input your whatever details. I think PPFAs would hire MBA students as interns after the interview. So please go ahead and you can apply. What is your view on Trump or Modi meeting and its outcome and impact on Indian stock market and sectors? First of all, I don't think, to be very honest, I don't follow these things. Because, like, for example, Mahanagar Gas, let's assume. Now, any piece of information that I consume should impact somewhere. Trump and Modi meeting, like for example, Mahanagar Gas, where it will impact. Uh, Cash flows of the company, it's doing business in Mumbai. So, meeting in US is not going to impact its Mumbai operations. Or let's say cost of capital, that is discount rate is anyway we are going to put at 12%. So, I don't think the discount rate will change. So cash flows are not changing, discount rate is not changing. Where what else would change? So with meeting, without meeting, Mahanagar Gas value per share is same. You are asking impact on the Indian stock market. I don't know. I'm not concerned about Indian stock market. I am only concerned about the stocks that I invest in. If there can be any negative impact, that impact will be for a temporary period, maybe 1 day or 1 week or 1 month. I am not concerned. I'm not concerned. So I'm okay. Like every now and then there will be some impact because of these things. So it's okay for me. So how is it going to impact and how is it going to change the way I invest? No, that is not going to change. You're asking sectors. I think they spoke something on AI and all, but is there any AI company or after this DeepSeek, any AI company business model would reach billions of dollars, all the investments and all. So is it worth it? Because Chat GPT on one end, OpenAI spent billions of dollars, whereas DeepSeek with few millions cracked the code and built, I mean, open source model. So I think they mentioned something about AI, but I'm not sure how the Indian market is going to impact. I'm not really sure. And I'm not really a macro guy, to be very honest. All these are macros. People look at all these things, observe these things, based on that they invest. But there are no, I mean, notable or successful macro investors out there. Because predicting is something that you can do once and get successful. But predicting based on the events and consistently making money out of that is very difficult. So that is the reason I look at companies. I place more emphasis on the individual businesses, stocks, valuations, portfolio diversification. This is where I focus more than trying to understand these things. And most of these things are anyway PR activities. So that's other. Uh, I mean, let's not go there. Can you guide us on the most lucrative opportunities for long term investment? So, if there is any lucrative opportunity for long term investment, I'll anyway let you know. So, recent lucrative opportunity that we have received is this Vindhya Telelinks. So, this is the last or the recent lucrative investment opportunity. As and when we find some more, definitely we will let you know. Mahanagar gas was not in the list of that is what you check when we were doing this Feb report. Mahanagar gas share price was much higher, so it was not in the buying zone. That is not that is the reason it's not in the list. One second. Yeah, last week when we download your Excel from screener, we do not find the smiley or sad face icons nowadays. They used appear early. Any specific reason why they have been removed? No, nothing is removed. The file is the same. Vindhya just now too far downloading. While analyzing the above stock, the answer are equity above. I think you did some mistake. I think you just contact the team. I think you have made some adjustments or something is wrong with the Excel file that you have got. You can clearly see like I am exporting all these Excel files from the screener, and as all the smileys and all they are working fine. And our returns are on equity consistently above. Something is wrong. So something is wrong with the Excel. So please, I think you need to upload. Please upload the original file that you have got. Upload it again, and then you will see the difference. Can we hedge our holdings with Nifty option buying? Options and all, we don't do that. So if we sell according to MSP, how can we make 5x or more on a particular stock as the MSP may improve with the fundamentals of the stocks as you once said? I'm so sorry, Arun Tulasi, but that is what SEBI wanted. So I cannot, you know, I don't have anything to say about that. Yes, MSP will grow, it can happen, but when SEBI doesn't want me to give a follow-up report, and if I give any report, they are considering it as hand holding and imposing fines, penalties. I don't know. Even canceling the licenses and all, keeping 6 months ban, 3 months ban, 1 year ban on license. I don't really understand the logic. Yes, whatever you have mentioned is right. Potential, I can increase the exit prices if there is more potential. I mean, if the fundamentals improve and all, but now we don't have that option. We are not going to write any follow-up reports from now on. Only one report will write. So in that one report, we'll give you buy, we'll give you target price, we'll give you maximum MSP, maximum selling price, and that's it. We cannot write a follow-up report. We want to, but we have done that, right? So previously also we have done that, but I don't know what is why SEBI doesn't want. I don't know. So from now on, we don't want a follow-up report because we'll end up in trouble. So that is the reason. KS Kishore, if the stock is down 25%, then 50% shall be. No, I mean, since it is down, significantly, it's better you don't exit from that valiant. Remaining you can. MGL, I think most of you are asking me the same question. I think Mahanagar Gas, why it is not in the Feb list? It's because when we were doing this shortlisting, Mahanagar Gas was not in the buying zone. Currently, it is in the buying zone. Today, it is in the buying zone, but when we were doing it, it was not in the buying zone. So that is the reason it was not in the Feb list. When and why to buy is clear, but when to sell is confusing. Very simple. I'll explain once again when to sell. So with every stock you have bought or you will buy in the future from our end, you will get this report. Okay, for example, we have started this with Vindhya Telelinks. This is target price. For example, you are buying at 1667 today. You are holding it well and good. Target price is what you are looking at. 3300 is the first target. You buy it, you sell some quantity at that price. And slowly, as the share price moves up, you will slowly liquidate. MSP is maximum selling price. So by the time the stock reaches 3960 rupees, you should fully exit the stock. You have to fully exit the stock. At 4000, you shouldn't have any quantity left. So that is the maximum selling price. Here, you have MSP for Vidya Telelinks. But what about, let's say, Mahanagar Gas? Because with Mahanagar Gas, MSP was not mentioned. So what I am going to do is, in the future sessions, weekly sessions that we have, so in the future sessions, I will cover all the stocks that I have recommended previously. And I'll analyze those stocks, value them, and then I'll provide the MSP for those stocks also. So you can keep track of it. Or it is in the video format anyway. So for example, whenever you feel like when should I sell Mahanagar Gas, there should be a session on Mahanagar Gas. We will share it with you anyway. So you just watch that video and you will get to know what were the exit prices that I gave you. Of course, it's you have to track from now on. Previously, I used to track, but somehow SEBI didn't like it. So SEBI is like the client should take care of himself. Like you should not do any hand holding and all. I don't know. I clearly don't know the logic, but it's not in my control. So what should I do now? Uh, Kindly inform us the newly added item MSP for your older. That will also good enough instead of generating. What do you say? No, no. That is what I am saying. The MSPs I'll cover going forward. I'll cover all the MSPs. I'm following you since April 2023 and I have around 20 lakhs in your suggested portfolio from which I have sold 50% and parked in liquid fund. My question is I have some mutual fund investment also which have been running since 2017 which is double enough. So whether can I convert 50% of it also in cash? So the mutual funds that you mentioned here, what exactly is that? Is it a multi-cap, large cap, small cap, mid cap? So small cap, mid cap, it's better you convert. I mean, if it's a flexi cap or large cap, it's okay. But small cap or mid cap, extremely overvalued. So you better convert it into cash. But again, you didn't mention what exactly it is, but you know it. Based on that, you do. 10% negative from 20%, total 30%. Srinivaslu Vayaguntla, strategy in the... No, I mean, there is no strategy here. You just hold. That's it. So Premlata is asking me, I joined in October 2024 and out of 24 stocks, bought 15 stocks at 30,000 each in lump sum, not SIP. I still need to buy 9 more stocks, 30,000. I have kept 2,70,000 for the same as advised. I'm not buying now, waiting for the market. My question is, what if when the market falls and the price of the stock you recommended increases? No, No. When the market falls, there is huge panic, huge supply. Everyone sells. So my recommended stocks or anyone's recommended stocks will fall. That is what market crash is all about. When the market is crashing, when everything is falling, why would some stocks go up? No. When there is a market fall, every stock will fall. My stocks, my recommended stocks will also fall. No doubt about that. Are there any possibilities in such market crash? No. Generally, no. Not possible. You are asking whether any stock price increases. When the market crash happens, you know what happens? Entire Sensex or Nifty would go into lower circuits. I don't know whether you know this or not. There were instances in the past where Nifty Sensex fell and touched lower circuits, back to back lower circuits. Nifty touched lower circuit after 2 hours break. Again, the session was started. Again, it went to lower circuit. That's what happens. So, no. Is it a rule that in a market crash all the share price drop, or exception to this? Can a share price also go up? Again, if there are 5,000 stocks going, no, one or two stocks may fluctuate. They can be in positive, but generally, if it's a market crash, all the stocks fall. All the stocks fall. So why one stock would go up, or I mean, it's a random thing, but generally every stock will fall. 2 days session is more. I never get doubts. Kindly consider making. Yeah, I mean, it's recorded. Yeah, it is recorded. 1 second. Yeah, I'm recording it and I'll share it with you. I mean, I'll share it with everyone. Can you update MGL report with MSP sell price for all older stocks report also? No, I cannot touch older reports now, and I cannot write new reports on older stocks now, because one report I can only write one maximum report for one stock. So I cannot change anything in the older one. So what I'll do is, like I already mentioned, I'll do separate sessions where I will cover the MSPs for all the stocks that uh, which were recommended in the past. If we exit accordingly to price mentioned, then have to get 10x or 5x if we exit early. So please help us drastically, because we cannot have stocks like RVNL, Utco and all. Please mention, hold, we have public appearance. Hold on. Now, what I'll do is, anyway, we'll be having weekly mentoring sessions, right? So there I can speak of stocks. When did I tell you, like, I'll not mentioning anything about my previous investments? I never said that. All I said is I'll not write a follow-up report. You attend the weekly mentoring sessions. Anyway, in the weekly mentoring sessions, we will be discussing about stocks. So it's not like I'm not going to talk about Mahanagar gas in my lifetime. I never said that. So if Mahanagar is in the selling zone, or first exit or second or third, or I feel not the right time to exit, I can do that comments and I can call it as public appearance. I can do whatever I want. All I mean, I cannot write a report. I can talk on Mahanagar gas. The entire session I have done today taking Mahanagar gas. You know why? Because I already have a research report for that. So I can speak about that stock. So I may not write a follow-up report on a stock. But when did I say I'm not going to talk about that stock? I am going to talk about every stock that is recommended. And I am going to talk about all the exit prices also whenever it is required. For example, 2 weeks from now, one of our stocks is hitting the exit price. I may not write a report and share, but I can tell you that this stock that I have recommended is in the exit zone. Go and check. I can do that. I am not breaking any rule, right? I have the research report. I can talk about that stock, but I cannot write a follow-up report. The only issue is with the follow-up report. I cannot write a report and sign it again and show that I gave a buy, I gave a sell. That is hand holding. I can speak. No one is stopping from speaking. So don't worry. So RVNL, Hutco kind of investments, don't worry about that. For example, if the exit price is triggered, and if I feel that uh, the exit price is far away from that, I'll do a separate session on that and I'll tell, like, in the report the exit price is this, but I feel the exit price is extended. So wait, I can do that. I'm not breaking any rule. I can talk about that stock because I have already recommended it. I have the research report. I can talk. So that I'll do. So don't worry. Banu Ganna money. So don't worry. We can do that. Some stocks have multiple reports, say Axis Bank in multiple months. So no, we only have one report on Axis Bank. Or let me check. I'll check and let you know. I only have one report on Axis Bank. Why would we write multiple reports on one stock? One second. Axis, we have only one report, that is in November 2024. So only one report I've got for Axis Bank. People ask some, we are thankful. So thank you, Shilpa Bane. While buying on SBI securities, I got caution as it is getting scheduled to move on out of derivatives and also being less traded last. I shared the screenshot. While buying SBI securities, it's okay. SBI securities is okay. Like, I mean, it's not a bad stock. While buying on SBI securities, you mean which stock? I got caution as it is getting scheduled to move out of derivatives and also less traded in the last 30 days. Which stock? I mean, Srinivas Raju, you didn't mention the stock. You mean to say SBI securities, or you mean to say there is some stock which where you got? Or is it Mahanagar Gas? I mean, exactly what? You can put this question to the team. We'll get back to you. KS Kishore, the stocks that you have mentioned, like, if you if the fall is like 20-25%, so then you can ignore them. You can basically book profits or cut in some other stocks, and then you can stay 50% in cash. I mean, you can do whatever you want, but these are already down, so it's better you do it with the remaining stocks. Many stocks prices around 50% from profit could have, like Philatex. Yeah, I mean, don't worry, Gauri Shankar, it's okay. Like, market keeps on fluctuating. So you hold on. Like, one thing that you need to do is, if you if you can do one thing, that is like, in panic exiting full portfolio, that is something you should avoid. This is temporary. So in the long term, all this fall, this doesn't matter. So there is no need for you to panic and all. It's okay. So stay the course. In the long term, whatever pain that you are feeling today, I mean, obviously it's very difficult, but it's okay. Don't worry. This is all temporary. If you sell, it will be a real loss. This is paper loss. So don't worry about paper loss. And if you want to invest in stock market, then you have to go through paper loss. There is no other way. So gains and profits, gains and losses, again gains, again losses. It's all part and parcel of stock investing, which is fine. So let it fall. But once the rally happens, I mean, all the stocks go up, and again the portfolio will be in positive. Anita is saying, can I sell idle gold and buy stocks as I don't have cash now fully invested? Anita, you can sell gold, buy stocks. That is fine, but not here. Like I said, the best time to buy is uh, market cap to GDP less than 90% is what I am waiting for. If the stock market hits let's say 70 or 60, like COVID, uh, similar to COVID, I don't know whatever I'm going to sell. Like I will sell everything. I have a chain here. I may sell this also and I'll invest if such opportunity exists. I also, when there is a lot of gold, so I'll liquidate everything. So I'm also waiting, but not this time. This is not the time where you sell gold and invest. Do you think market is trading at that favorable price? I mean, you you sell assets like gold or some jewelry or something like that. You sell when you feel like, okay, this opportunity may not come for next 5 6 7 years. That point you can sell gold, you have land, you have whatever you can do, but this is not that time. You still have, you still got some time left to reach there. Here, don't invest fresh capital. No. I'll tell you one thing. What if you invest here? Let's say you stay in the market for next 3 years, you invest here, or you invest wherever. If you stay in the market for 3 years, you will make profits. But the issue is, making profits is different. Multiplying portfolio, like, multiple times, that is different. I'm waiting for that kind of an opportunity. And when that kind of opportunity comes, that idle gold is more helpful. Got it? So, no. And one more thing, gold is the best hedge against the stock market. Equity, the best hedge against equity is gold. When stock market crash, the price of gold rapidly increase. So you have the best hedge against equity. So why do you want to sell your hedge? Let it be. When market falls, gold prices go up. Gold is the first thing people go and invest when market falls. So you have idle gold, that price will also go up. So let it be. So this is not that kind of a market. So please don't do that. I invest in which liquid fund? Any liquid fund is okay, but go for any bank, for example, HDFC liquid fund or ICICI. Any liquid fund is fine. I mean, not. I mean, I generally go for a bank. Let's say ICICI or HDFC, SBI. But there also you can diversify. You can invest in three or four if you want. So banks, preferably banks. You are telling about market cap to GDP. What can we do? Your monthly stocks, can we wait? Monthly stocks have to provide because there are monthly investors. SIP people are there, so they have to invest monthly. If you have already invested lump sum amount and you are in cash 50%, then you can ignore the new stock ideas. You can ignore that because mostly, since we don't have the best time for lump sum right now, mostly I'm doing the list for SIP investors. Again, it's up to you. We have one new stock. If you want to add that one new stock, it's okay. One new stock, fine. If you want to add, you can add. But too much of capital, don't try to get that capital involved here. One stock, new stock is fine. You can add that. I want to invest every month 5,000. I'll wait for 10 years. Kindly. You have, I mean, invest one new stock every month. Do that for next 2 years. You will have 24 stocks. After 2 years, you keep on selling from here, buy new stocks. So it's very simple. So for example, you have, I'll show you. I think this I'll cover. So for example, you want to invest 5,000 rupees, right? So capital is 5,000. So here what you will do is, this is uh this is the month. This is the month. This is the amount, and this is the stock. So what you will do is, stock A. What does it mean by A? It is a unique stock, different stock. Stock A, stock B, stock C. You buy different stock every month, not the same stock. So what you will do is, for next 2 years, for next 2 years, okay, for next 2 years, you basically do this. These are all unique stocks. So month one, let's say you bought uh, Axis Bank. Month two, you bought, let's say, NRC. Month three, you bought ONGC. Depends upon the ranking. Like whatever stock is at the top rank in that list, you basically go through the same process and you buy. Now after 24 months, which is 2 years, you can do it 2 years or you can do it 2.5 years, where you will have 30 stocks in the portfolio. It's up to you. 24 stocks or 30 stocks, 2 years or 2.5 years, it's up to you. Now, investment amount is same, but the stocks are different. So in next 2.5 years, you will have 30 stocks. Now, once you have 30 stocks, then comes, throughout this, you will be buying. You will be on the buying side. From here, or you can do, let's say the maximum holding period is 2 years, right? From here, what you will do is, you will sell this stock because it's already 2 years. You will sell this. You will get some money. With that money and whatever the extra money you want to add, you will add that in the 25th or 31st, wherever you are selling. You will add that. The next month you will sell this. Next month you will sell this. You get money, you add into the new stocks again. So any given, after 2 or 2.5 years, let's say after 2 years, let's keep it this way. After 2 years, you will have 24 stocks. For the rest of your life, or as long as you are doing this SIP process, the maximum stocks you have is only 24. Because you are selling one, you are buying one. You are selling one, you are buying one. So first 24 months you are only buying. From 25th month, whichever stock past that 2 years, you will slowly sell them, buy new ones. So that's the process. So this is something that I want you to follow. And you said 10 years. For 10 years, the process will be the same. This is what you have to do. IRFC, I mean, we gave exit long back. So you bought at 40. Yeah, I mean, IRFC is overvalued and we gave an exit long time back. It's okay. I mean, you want to hold it or you want to exit. We have already given exit. So what suggestion can I give it? I mean, what suggestion can I give? Because I already gave an exit, right, for that stock. Axis is also one of our recommended stock, and it is in the buying zone. Yeah. Is it worth to invest in IPOs? Generally, I don't invest in IPOs because, timing, price is decided by the owner of the company. We don't have any advantage. Why would he sell his company at a lowest price, undervalued price? Generally, they don't. They want maximum price from us. So we don't get undervalued stocks over there. Leela Kumari, Vishnu, can I do tax harvesting now? My realized profit is 15 lakhs this year. Go ahead, you can do tax harvesting, but there is a catch with this tax harvesting. It's difficult if you buy the same stock. For example, you are selling Valiant, offsetting your gains, and again buying the Valiant. That's an issue. You can do it with an identical stock or identical mutual fund, something like that, but not the same stock. If you buy the same stock, tax benefits may not apply. So there is a risk with that. You cannot buy the same stock after doing this tax harvesting. So that is up to you. Again, if you want to do tax harvesting, you can do, but once you sell it, you cannot buy the same stock. If you buy the same stock again, the benefit you won't get it. So that's the issue. What if I don't exit 50% of the portfolio during 2025 fall and follow your research reports to sell the stocks? Completely fine. It's completely fine. But Mustafa Beg, if you do that, you need to understand one thing. There will be some pain in between. If you can withhold that, then go ahead and wait for the stocks to reach the exit zones. The only thing is there can be some pain in between that. There can be a deep fall which may force you out of panic or something like that, which may force you to sell. So only that, only because of that reason. And one more thing is, if you have some cash, when the market goes down, maybe you will get a better opportunity there to average down. Only that. But if you don't follow that, it's completely fine. You can sell according to the research report as and when. Of course, market will not fall forever. Market will not go up forever. It will fall and it will rise. It will fall and it will rise. So this is a natural process which will continue forever. Right now it is falling. After some time, whatever the time, it will again rise and it will again rally. Again it will fall. Again there will be a rally. So as simple as that. Right now we are in the fall. So if you just want to follow the research report and all, just you have to wait for the rally. Now once the rally is back, again the stocks perform, you will get the exit prices. Guys, I think we should, yeah, it's already 3:40. I think I should end the session at 4. So I'll take few more questions and then I'll end the session at 4. I've invested 9 lakhs nearly in the recommended stocks. What about your new ideas? Vindhya Telelinks, should I invest or just wait? No, Vindhya Telelinks is a new idea. So it's in the buying zone. You want to add, you can add. I'm not stopping you, but again, do you have some cash left? Uh, if you have some cash left, then some amount you can invest here. But if you don't have a lot of capital or you are only with like very few, I mean, for example, you invested 9 lakhs. So do you have 9 lakhs more? Because 50-50, if that is the case, if you have 9 lakhs more in the liquid funds, then you can invest a little here in this stock, or else just ignore. You can do that. Have hedging of portfolio done? Please explain. No, I don't know. I don't do any hedging. But one thing I know is, like someone mentioned, gold, right? So gold is the best hedge against equity. For example, you have a portfolio of stocks and equity is falling 20, 30, market crashed. Whenever the market is crashing, the first thing that happens is the gold price goes up. Because gold, people consider gold as safe haven. So they sell stocks, they buy gold. So that's what. So gold is the best hedge if you ask me. Ravi Menon, why don't you advise on Repco? What Repco? Repco is one of our recommended stocks, so I don't get that. ADV, what does it advise you mean? You can hold it. So Repco is still a great stock, so you can. I think I didn't get the question first of all. So you mean advise on Repco? If you're asking me advice, then it is hold. Santosh, I have total capital 30 lakhs with more than 50 stocks. Out of that, I invest around 20 lakhs from your recommended stocks. Now it is overall 6 lakhs gain I have. Do I need to take out 50% of it? Shall I hold to average it later? No, you are making profits of 6 lakhs, so it's better you have something in cash. So, I mean, why you have 30 lakhs? So out of that 20 you have invested in my recommended stocks. You made 6 lakh rupees profit. So book profits. That is what I would say. I am unable to understand whether new ideas are for investment or just we have to wait for larger dip. No, I mean if it is confusing, you can go and invest in that one stock because I have not included like 5 or 10 stocks, right? So there is only one new stock. Okay, if you have joined recently, then all those are new ideas for you. But all those ideas are already existing investments which went up again came into the buying zone. So only this stock, only Vindhya Telelinks is the new idea. Remaining are all old stocks only. But they crossed the MBP and again now after this fall they entered the MBP. Uh, my portfolio was profitable and I booked the profit now 2 lakh negative. Should I hold or book loss to minimize tax and buy again? No. If you book, okay, there is some misconception regarding tax harvesting. One thing you need to understand is yes, tax harvesting can be done. For example, you have two stocks, Tata Motors and let's say Bajaj Finance. In Tata Motors, you made 5 lakh rupees profit. In Bajaj Finance, you made 3 lakh rupees loss. If you sell Tata Motors, you have to pay tax on 5 lakhs, right? So what you can do is you can show 5 lakh rupees as profit. You can sell Bajaj Finance, which is 3 lakh rupees loss. So you offset the gain with the loss. 5 lakhs minus 3 lakhs, which will be only 2 lakhs. So you pay taxes, of course, 1.25 lakhs is anyway exempted. So you pay taxes for some 70,000-80,000 gains only after exemption. Now, the point here is if you buy back Bajaj Finance again, then this whole tax harvesting will not work. You cannot buy the same stock. That is the minimum requirement. If you buy back the same stock, then it comes under the tax harvesting and all. Like, you think government is stupid or what for you to encourage the tax harvesting and all? No, you cannot buy the same stock, but you can buy a similar stock. For example, if not Bajaj Finance, you can buy some other finance company in the same industry, which is undervalued. You can do that, but not Bajaj Finance again. So you are saying like I have booked some profits now I'll sell. If you sell that, if you book losses, then you cannot buy the same stock back. So remember that. How can we add call triggers to receive mail or portfolio tracker remarks? It will be helpful to all. I mean, for example, if you are using screener, screener can help you with that. But I think for that you need after a certain capacity, you need premium account, I guess. For first few, it is free, I guess. Let me show you. So you are saying what you mean to say is share price triggers, right? So, for example, ICICI Bank, you can go to chart, you can go to alerts. Now you can keep an alert here. If the price goes above, let's say, what is the current price? 1260 is the current price. For example, if the price goes above 1300, reminder is sell. Okay. So as you can see, current price is 1260. I want a trigger. Whenever the price goes beyond 1300, sell. That is the trigger. If I save, whenever the price is above 1300, screener will directly send you a alert on your mail. So you can check and you can use this. But I think there is a limit. If you are using free account, there is a limit. If you are using a paid account or there is a premium access also, if you are using a premium one, I think uh, it is unlimited. It depends like how many you, whether premium is required or free is more than enough for you. That's up to you. You decide. Smita, you mentioned that we keep 50% cash to invest once there is a great fall. But right now, our portfolio doesn't have stocks with 50% profit, so can't sell these stocks. How to address this and keep? No, I mean, uh, if you don't have cash, or is there any way that you can source cash later on when there is a fall? If that is possible, then you can hold. I mean, you can fully keep them invested. But no, I mean, I have already advised, but Smita Bapat is asking me. So the point is very simple. If you have cash, if there is a big fall eventually, that cash will help you. Let's say you don't have cash, you can, uh, I mean, pull out some money from here, whatever you are existing. Or if you don't want to do that, then very simple, then either the market goes up and you get to liquidate the stocks. Maybe that can be a way. Or else the market falls and you just hold. You just hold without selling. The market will revert back and again the stock portfolio will be in profits. So anyway, if the market goes up, then you will get a chance to exit. I mean to get into cash. If the market falls, then you may not have a chance. Then you have to hold whatever the stocks you have. You just keep holding them. I know individual shares are not much controlled by market scenarios. Uh, they can have impact. What says entry price is much higher than. So what you suggest, if entry price is much higher than the current price, then also we should wait and wait or invest. They can, but may not affect it. So what is entry price is much higher than current price. If the entry price is higher than the current price, for example, if the entry price is 100, current price is 60. Is that what you mean? Then it is undervalued, right? So if it is undervalued, then you can invest. You mean right now? Again, it depends on where you are. See, the point is very simple. When you have cash, you want to deploy. It's very difficult to not being active. Just sit and wait, it's very difficult. But the thing is, everyone who is asking me, there is this new idea, should I invest or wait? My answer is very simple. Whenever there is a very big fall or very big market crash, you need to understand the level of crash. For example, let me show you what can be how a crash looks like. For example, 2007, you see this, this is the peak. ICICI Bank, by the way, this is not any penny stock or anything like that. This is ICICI Bank. Peak of 2008 bubble. ICICI Bank was trading around 260 rupees. How much? 260 rupees. Then the market crashed. 60 rupees. 260 to 60 within 1 year. So 1 year, how much is that? So 260, 26, almost 70% fall, right? 60-70%. That is ICICI Bank. ICICI Bank is a large cap company in 2007-8, also one of the biggest banks of India then also. And it fell 70-80%. Now you tell me what will happen to mid caps or small caps or whatever caps. So try to understand the reasoning why I am saying have 50% cash. Large caps will fall 50, 60, 70%. Small cap, mid caps will fall 90% if it's a really big fall. What can be our fall since we have invested in undervalued stocks in the lot in the small cap and mid cap? Our stocks may not fall 90%, but our stocks will also fall. Not 90% or 70%, maybe 20, 30, 40%. There is a chance. So you can buy them back at a much lower levels, is what I mean to say. Now we have a new stock. Should I invest in this? That is up to you. That is up to you. I have no issue if you invest in this new stock or not. I have no issue. But you don't have cash is my issue. If you don't have the cash, then I am saying it time and again. I am repeating it multiple times. If there is a crash, then it will be a bloodbath in the market. So please try to have some cash. That cash will give you a lot of peace. It will help you because it's going to be a lot painful for you. Anyone. And most of you are here for the first time. So you need some cash so that you can deploy and average down. So new stocks and all you are buying or not, I'm not going to take that seriously, but please get some cash. I'm not saying market will crash tomorrow. No, market may not crash tomorrow, but whenever there is a crash, market can double, triple also from here. I am not saying that there is no chance. What I mean to say is I'm just preparing you. Mentally, I'm just preparing you. This can happen. So be ready. So that you can face it whenever it happens. Please suggest me where I can deposit my cash. Nearly 70 lakhs. I sold stocks but again want to enter. Please suggest where to keep this liquid money. So I have my liquid cash in the liquid accounts only. Liquid funds. Bhattacharya is asking me. So liquid funds. Uh, or please don't do FDs. No. Please don't keep that much of cash in savings account also. Because like all this cyber crimes and also it's better you uh, invest that money into liquid funds. That would be much better. Personally, I invest in liquid funds. And people generally ask me like what liquid funds and all. I don't do much analysis in terms of liquid funds. Of course, there is a 3 star, 4 star, 5 stars. There also cello. Okay. I mean, let me show you 1 second. I hope you can see the screen. There will be ratings, but cello will only keep 3 stars. One second. Debt liquid. Enough of your ads. So you can see these are the liquid funds, top rated ABSL, that is Aditya Birla. I have this Bajaj Finance, I don't have. Edelweiss, I don't have. Mahindra, I don't have. Axis, I have. HSBC, I have. Mire, I have. Nippon, I have. Bandhan, I have. Canara, no. ICICI, yes. I have invested. Invesco, yes. Kotak, yes. LIC, yes. SBI, yes. Tata, yes. UTI, yes. So as you can see, I've invested in lot of liquid funds. So again, diversify there also. So nothing wrong, right? You have 70 lakhs. So you can also buy whatever, like whatever I have mentioned, you can go and buy. So these are all 3 star, 4 star, 5 star. So mostly I prefer banks. Kotak also I have. Mostly I prefer banks. I have covered all the banks first. Then I've gone for LIC or Canara Robeca, Invesco and all. Then I have invest. So that you can also do. Not a big deal. This is something that I would advise. So it's better you go for liquid funds. And one more thing, you need to understand like what kind of returns you can generate. So you see here, this is the last 1 year return, 7%, 7%, 7%, 7% and all. So 7.4 to 7.44, 7 point. So mostly all 7.4, around 7.4. So return is also, you can see moderate, low to moderate, low to moderate, low to moderate. And you can see all the funds that I have invested like Tata or SBI or UTI, LIC, Kotak, all are low to moderate risk. So you can go ahead and invest there. I invested in I invested 40,000 in 4 stocks. Why is it a lump sum investing or is it monthly? Hari is asking me this question. You invested 40,000. Okay, you are in loss because market is going down. But the point is, have you invested as a lump sum process or is it a monthly investing? If it is a monthly investing, then fine. That means you are investing 10,000 rupees every month. You please continue it. Please keep doing that. But if you have invested 40,000 in 4 stocks, then why only 4 stocks? That's the question. Because 4 stocks is not a diversified portfolio. 4 stocks is not enough. So why? And with 40,000, you could have easily gone up to like maybe minimum 5 to 10 you can do. You could have done like 6 or 7 also you could have done. So 4 is very low because minimum 5 is something that we go for. But it's okay. Don't worry. Just hold the stocks. It will, the market will revert back. Don't worry about that. Today's question, SIP in the market. Suppose a customer having 6 lakhs in hand and time period is 5 years and want to do SIP of 10,000 per month. If he did so then total stocks in 5 years will be 60, but in our process we will invest maximum 30 stocks. So if we suggestion regarding SIP portfolio management, then I think I have just shown you that, right? So first 2.5 years you will just be buying stocks. But once you have 24 or once you have 30, then you will sell one, you will buy one. So you keep on having 30 as the number forever. You will not go beyond 30. So I think I have already covered that. So whether you have 6 lakhs and all, 6 lakhs will be your lump sum portfolio. Again, don't mix lump sum and monthly. Lump sum is different, monthly is different. Stocks can repeat, that is fine. But lump sum, keep it as lump sum, monthly, keep it as monthly. So overall, if you combine them, maybe you will have 60. But they are two different process. The process is different. Repco Home financial health is strong. But It's a financial company, so the debt to equity ratio and all will be high because it's a financial company. Heard about AI based stock investment and trading recently with subscription on monthly basis and so. How far it is genuine or precise? I am not sure. I mean, how precise it is or how genuine it is, I'm not sure because at least we don't do any of that. So AI based stock investment and trading. See, AI end of the day, uh, number crunching or let's say financial modeling or that AI can do without a doubt. But how accurately it can do, like how precisely it can do, only time will decide. So I'm not sure, like how not enough data to comment on. Maybe we'll wait for 2 years or 3 years or 5 years, then we'll get to know like how efficient it is. But right now we are in the AI bubble, to be very honest. Like there was a time we were in tech bubble. Like you just add tech in the name, the stocks would explode. Companies would want to add tech in their name, like infra tech. What infra tech? Because infra companies also started tech in their, adding tech in their names. And half tech bubble busted. Now people are adding AI. AI is the new bubble, so it will also bust. I'm not saying AI is not helpful. Like internet is helpful, right? Tech companies are helped us tremendously, but there will be a bubble. The bubble has to bust. So I think AI is in a bubble stage. Let it bust. And recent DeepSeek and Nvidia, what happened and all. So we have already seen. How do you decide about MSP? MSP is nothing but maximum selling price. Again, I have shown you the exit prices, right? So that is how we do it. Santosh, what is the question? At this stage, is it advisable to invest in companies working for water management? What video you have watched, Vipul Shukla? Like you are watching all these reels or what? Water management and all. Because these days people are pumping all the water management and all as if it's a new technology that the world has ever seen. So, what stock in water technology? What stock? All these pipes and all. You mean Astral pipes and those stocks? You mean? Is it in the water management, plumbing, so on so forth? This is what happening. 68 P. What else? What else? Water management. Go and check their P. Please stop watching all the reels, YouTube shorts, Insta reels, and all. You will save yourself from lot of trouble if you stop watching YouTube reels and Insta all those shorts videos and all. It's why I'm saying this is because I've also seen like they mentioned some companies and I've checked. All are like in the bubble. Every company is in the bubble. Extremely, extremely, extremely overvalued they are. So please stay safe. Why not provide your Excel? No, we are providing the Excel. You just ask the team, they'll provide you. So you can just go and check entry and exit and all. So that will be provided. Vineet Kumar is asking me, I have invested around 1.2 crores since last 1.5 year and my profit was around 15 lakhs but now showing loss of 25. But still few stocks are in little profit. Will you suggest to book profit from the profitable stocks and depute that money in the stock which are trading lower than 25% of period? Buy, but anyhow I have strong believer procedure of recommendation. See the point, Vineet, what's happening here is You invested money, you saw profit. Now the portfolio is down. Now what you are trying to do is you want to do something with it. Action bias we call it. And everyone has this action bias. So do something bias. No, you don't need to do anything. The only question I am asking you is the market fall, if the market crash 50% from here, are you prepared? That is the only question I have. You sell 25, you add here. I don't want to hear any of that. I am saying, like you said, I am strong believer of your procedure of recommendation. Vinith, I am asking you very simple question. If market falls 50% from here, are you prepared? When I say are you prepared, like how much cash you have left? When there is a fall, do you have any cash or this 1.2 is full? If this is full, then get into cash. Because 1.2 CR is a big capital. So you need some money out of the market so that in the future if there is any big fall, you need to able to, if it is 2 lakhs or 3 lakhs, that's a different story. 1.2 crores is a different story. So rule number 1, never lose money. Rule number 2, never forget rule number 1. If you have, let's say, if you can say, Vishnu, I have 70-80 lakhs, I can bring whenever I want, then you do this. You sell 25, add here, average that, average this, you do all of this. But do you have cash outside the market right now if there is a big fall? If the answer is no, then please do that first. Please get some cash out of the market. Put something, you do, you invest in liquid funds or you put it in bank, whatever you do, it's up to you, but you need to have some cash. 1.2 CR, it's a big capital. So be careful. When I say carefully, I don't mean to say market is going to crash, but be prepared for that. So that is what I mean. Why don't you try to get license to recommend international stocks in the chaining scenario? There would no SEBI only control Indian market. So, but my license only permits me Indian stocks. SEBI controls Indian, so we have to stay Indian. We cannot comment on international stocks. So that is what it is. So guys, it's already 4. I think what is your gut feeling about the stock market? How much will it further drop? 20, 30 or more? Market will surprise or shock you. I mean, you say 20, it will fall 40. You say 40, it will only fall 20. So we cannot be right. I mean, whatever expectations you have, market will do better or worse than that. So I don't have any expectations. My expectation is not how much market will fall. My expectation is below 90 market cap to GDP. I'll go full in. That's what I'm looking at. My focus is not on what market will fall. How will I benefit whether those 30 stocks, those 50 stocks fall or not? How am I concerned? I am concerned about the overall, this market cap to GDP go below 90, and in small cap, mid cap space, the stocks get into um, you know very reasonable valuation. So that's when I can do something, right? So that is what I am looking for. In Zerodha, can we invest in bank liquid fund? How to invest? In Zerodha also you can invest, but not from Kite. You have to download coin. There is something called as coin. If you are using Zerodha, then mostly for buying stocks you will be using Kite, right? But in Kite you won't find any mutual funds or liquid funds. You need to download an app called Coin. Name of the app is Coin. So from that you can buy. It is also Zerodha by Coin. Sorry, Coin by Zerodha. Yeah. Can an NRI invest in Indian stock, and if so, does the person need to have Indian number for the OTP? Obviously, yes. My sister does this, so she lives abroad, but she has an Indian account. So while purchasing and all, OTPs would come to uh, our phone. Like we use that OTP in, SIM card. So for OTPs, we'll let them know the OTP and then they'll place the order. So yeah, that is the case. The thing is, like, if you are an NRI and if you want to open account here, then physical verification is required. I mean, you need to come. I mean, whenever you are here, only then you can open. From there, what you can do is, like, maybe you can use your mother or siblings, whatever. I mean, someone is here, it's better use them. Or if you have an Indian account before, just take a uh, take online account on that account and do that. But OTP is mandate. OTP is mandatory. Kirti Ramu, my portfolio down 20%. I have no money. Just hold on. Just hold on. Can we call this a crash or just a drop? I would say just a drop, not a crash. No, it's not a crash. Only drop. So, chalo, my dear friends, I think it's already 4:13. We have started at 9. So, I'll see you again next Friday, 9 p.m. as usual. So, and of course, this video, once it is ready, I'll upload and the team will share it with you. So, chalo, I'll see you again next Friday, 9 p.m. Till then, take care and good evening.